Welcome to the European market open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
Happy Friday. Here are your top stories. Amazon delivers. Strong results from the e-commerce giant help stem the rout in tech stocks. Today's market catalyst, non-farm payrolls. The Hawks have it. The BOE hikes with 4 of 9 officials pushing for an even bigger increase. While at the ECB, Christine Lagarde no longer rules out raising rates this year. Plus, on the brink, the crisis engulfing Boris Johnson's government deepens as 4 top aides to the Prime Minister resign.
Now, let's take a look at the futures. Of course, bonds under significant pressure, Tom, after we had a more hawkish tilt from the Bank of England and, of course, from the ECB, although markets still trying to figure out exactly what those 2 central banks were telling us. But then there's a lot of support from Amazon earnings that really blew everyone out of the water.
There's so many different cross currents for these markets now. The central bank policy, of course, of the ECB, the BOE, what's happening in the tech space, energy prices as well with oil, and we'll talk about that surely. In terms of how things are opening then here, just in the first few seconds of this Friday, the FTSE 100 posting gains of 0.4%. We're still getting earnings through, and we'll recap some of those, the likes of Intesa Sao Paulo and Carlsberg, just in the next few seconds as we wait for these additional indexes to open here in Europe. Again, the BOE, the Bank of England, coming in and raising rates to 50 basis points. That wasn't the surprise. What was the surprise was the split in the vote, and what is now looking baked in is another hike next month. The market's now pricing in 1% by May. In terms of the ECB, it wasn't the statement, it was Christine Lagarde's commentary during the press conference that was more hawkish, and again, walking back her previous insistence that a rate hike this year is unlikely. That is now in the cards, it seems.
Everybody, I'm going to place order to sell all my long positions on euro. So all of you guys who we hold it for quite a while, for a long time, so it's time to sell all positions on euro, and the price I'm looking to sell, as you can see, 114.48. Okay, I will show all the positions was holding during this time. So please make your adjustments. Please make all orders to sell entire position on euro, long and short positions. I'll speak to you later, guys. Stay safe.
Territory for the first time, I believe, since 2020. That's currently moving up again, about 9 basis points for the 5-year. The 10-year is also gaining 4 basis points as well in terms of the yield. Let's move on and see how things are playing out as we look to the future stateside. Non-farm payrolls, yes, that is the data when it comes to the economics, and the median survey for Bloomberg is about 125,000. Bo, there's been lots of warnings from the administration that this is going to be a challenging month, the month of January, because of Omicron. A whole load of different seasonal factors as well, so passing that number will be challenging. The future's pointing to gains of 1%, and as Francine was saying, it was really Amazon that kicked into gear after a rout of more than 4% on the Nasdaq. Meta, a record drop. We'll break that down, but it was Amazon came in with AWS doing very well and the advertising business as well. Nasdaq futures now up almost 2%. The US 10-year yield at 184, so comes above that 180 level, although there's been more action in the 2-year, the front end of the yield space, and Brent is at $91 a barrel. The more important story, arguably, is that WTI came in above $90 for the first time since 2014. Francine.
Yeah, that will definitely support a lot of the oil majors. And then we had that Goldman Sachs call saying that they're expecting WTI to reach 100. Tom, the main story, of course, is technology, one of the biggest gainers in today's trading session, because Amazon really blew everyone out of the water. If you think about how they did, for example, compared to Meta, formerly known as Facebook, if Amazon holds on to their gains of 14%, which we saw post-trade yesterday, then it will add 200 billion in terms of market cap today. So we're seeing technology up 0.7%, 0.7% higher in Europe. Energy also leading the gains, 1.2% higher. And then the only ones that are weaker, but still gaining overall, is some of the consumer staples, still the weakest sector, but gaining 0.2%. Then we look at yields in euro. There's a lot of movement in euro, with Sarah Vellis also changing his call, and that could change a lot of the corporates we're watching, Tom.
Yeah, some of the stocks on the move this morning. Intesa Sanpaolo returning, the pledge to return about 22 billion euros after beating with their latest results, currently up 1%. Sanofi as well, looking at double-digit profits this year. The drug maker gaining more than 1%, the French-listed drug maker. And Carlsberg, the drinks maker, was a beat for 2021, but they were also warning on the challenges around input costs as well as the continued drag from the pandemic. Nonetheless, currently up 1% for that Danish drinks maker. First to report out of the big names within that space. Francine, we're also looking, as you said, about technology. It's just remarkable what we're seeing in terms of the split between Meta and Amazon. And almost, as you say, almost Amazon's results almost making up in terms of the rally in the share price, almost making up for that record loss that we saw for Meta. Never in history have we seen such a sharp drop, $251 billion for Meta. Do we need to start to carve out the Facebook company, the Facebook owner, from the rest of the pack?
Yeah, I mean, I find the story absolutely amazing.
Yeah.
First of all, because I'm a user of both, and I can say with my, with my personal taste, and I have been using less Facebook. A lot of people in the newsroom say they don't even look at Facebook anymore, but probably we have been shopping on Amazon more, which is why, Tom, they were able to increase their prices on Prime. And then there's a beautiful piece, an opinion piece, which is actually my morning must-read, looking at valuations, but also just saying Facebook has a problem with short videos. This is what people want to see, and this is why some of their competitors are doing well, and they're just not.
Yeah, the Chinese challenger of TikTok really taking the fight to Meta there. TikTok, yeah, the ByteDance company, of course, coming in and challenging them in the video space. You can see this divergence just illustrated so nicely here in terms of this sharp drop-off for Meta, the gains of Amazon and Alphabet at Google, of course, as well. Francine.
Tom, you and I, on TikTok, I've made us an account. I'm going to keep it secret until we put something fun, and then we unleash it to the world. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Shares soared in late trading after announcing plans to increase its Prime membership price by $20 a year, the first hike since 2018. Amazon's fourth quarter profit topped estimates, led by its cloud computing division, which saw a 40% jump in sales. The company hired 140,000 workers during the holiday period amid supply chain bottlenecks. American Express is encouraging staff in the UK and in New York to start returning to the office early next month as COVID cases recede. The company has previously said most colleagues will work remotely at least part of the time, even after the pandemic subsides. Amex calls the plan a phased approach. Snap and Pinterest shares soared in late trading after upbeat results eased fears that a slowdown at rival Facebook reflected an industry-wide social media slump. Both companies topped Wall Street predictions for sales and earnings, with Snap even posting a surprise profit, its first since it became a listed company. That sent the shares of Snap rocketing up as much as 54% in extended trading, with Pinterest climbing as much as 32%. That's the Bloomberg Business Flash. Tom.
Okay, Laura Wright in London, thank you. So, a turbulent time in the markets, to say the least. We've seen big swings from those US tech earnings, as we've been discussing. The BOE and ECB decisions have rippled across global assets. Now investors look ahead to today's key catalyst. It's the US jobs report, so let's dive in to these market drivers then with our markets editor, Christine Aquino, and Bloomberg Intelligence TMT analyst, Matt Bloxham, who's going to break down the tech story for us with detail and analysis. Christine, let's talk about the non-farm payrolls then and how that factors in to the shift now in focus, away from the ECB and BOE, at least temporarily, back to the Fed. What are we looking for?
Well, Tom, obviously still those wage gain figures as part of that report will definitely be important. I think that will really, again, tell the story of how fast the Fed will have to go and how far behind the curve they are if that is indeed what's happening with these numbers today. And it's funny because, you know, you say it's non-farm payrolls Friday. I almost forgot because of all the excitement in Europe. I know. But, you know, it is still a very important number. And I think it will also kind of tell us the longevity, again, of this inflation story that's building in the U.S. and really everywhere in the world.
You're not wrong. I have to say, I mean, yesterday was not dull when it came to central banks. The Bank of England, the ECB, definitely keeping all the traders on tenterhooks. Matt, let's talk a little bit about tech valuations and tech stocks. It feels like yesterday there was a sell-off on the back of Meta, but maybe it was too deep and too strong, simply because it's like you're going to have tech companies that do well because people want their products, and others where they're just not going to have users because people don't want to be on that platform.
Yeah, I mean, yeah, sentiment shifts very quickly. And as you say, I think that there was a lot of kind of concern baked into some of the comments from Meta this week about the impact of TikTok, the impact of Apple's change in ad tracking, which, you know, was leading to a very sharp slowdown in their outlook for Q1 revenue. So saying there's about a 7% growth, down from 20% in Q4. Analysts were expecting 15%. So kind of real big mismatch there in terms of expectations. And yeah, you know, the technology industry moves on at a rapid pace and they're struggling to keep up. You know, you mentioned short video. They've introduced Reels on Instagram. It's gaining traction, but it's not there yet. And it's still got some way to go to kind of rein in the impact that we're seeing from TikTok.
Matt, what stood out for me is the difference in terms of Meta and the businesses of Meta and Amazon, and the strength of Amazon with AWS and, of course, Prime coming through and being able to raise those rates for Prime subscriptions. And then, of course, the e-commerce part of the business, which lagged a little bit, versus Meta, where advertising dominates, 97% of revenues. Yeah. And, of course, Amazon has the advertising chunk as well. They carved that out for us. That portfolio of businesses for Amazon really coming in as a strength at this point.
Yeah, that's right. That kind of broad-based platform really helping them out. And actually even their ads business, $10 billion of revenue, so about a third of the size of Meta's. It's quite a different style of advertising. It's what's called in the trade is trade marketing. So it's more, you know, if you went into a store and you saw some kind of promotion for a product, it's that kind of stuff below the line. So I think that's going to be more resilient to some of the pressure that Meta's seeing from TikTok. It could have been such a different story, though, for Amazon, because essentially their Q1 outlook for revenue growth was a bit shy of analyst expectations. So I think that price increase on Prime that they announced really saved them, I think, to some degree. But it's definitely going to help the business, about $3 billion of incremental high margin revenue, perhaps, which will help to kind of offset some of that inflationary pressure they're going to see on wages, logistics, all those other costs.
Christine, I mean, the million-dollar, gazillion-dollar question is actually, you know, whether some of these tech companies, and Tom had this great chart really looking at valuations overall, on whether some of these tech companies were value growth or growth stocks. I mean, do you actually now have to make a difference on whether you're a Meta or an Amazon?
Absolutely, Francine. I think that divergence chart that Tom showed earlier was really fascinating in kind of just marking how the story of tech is really shifting in 2022. You know, it's not just, investors are not just lumping all these big tech companies into one homogenous group, much as how they're differentiating now from profitless tech versus big tech, you know, and it really is the story this year. It's all about differentiation. It's all about parsing through company fundamentals and seeing if they have anything else to offer beyond the froth that they have kind of enjoyed over the last couple of years. And certainly the difference, the vast difference that we're seeing in terms of Amazon's business and results versus Meta really tells that story and drives that point home.
Christine, just the last on the central banks then, looping back to the ECB, the BOE, as we look ahead to the Fed, the reaction, of course, and the pricing around the non-farm payrolls. Where are we in the market pricing on the back of this central bank action? Francine has been talking correctly about the lack of clarity, the lack of transparency around some of these decisions. Yeah. Where are we in terms of pricing?
Well, Tom, there's definitely a uniform ramp up in traders' expectations for where the ECB and the BOE are going to go this year. Most notably, of course, traders now betting that the ECB will exit
its era of negative deposit rates. I think that would be the first time in at least 7 years. And that really tells you where the sea change is going. The direction of travel is really towards positive rates, positive yields, heading towards, we're heading toward there here in Europe. And of course, that would be a massive shift given that Europe has been the bedrock of negative rates and negative yields for years and years.
Yeah, I mean, this is the story of the day, that and of course some of the tech valuations. Thank you both for joining us. Christina Kino, Bloomberg Intelligence CMT analyst, Matt Bloxham, joining us for a good roundup of what we're looking in the markets. And actually, my chart of the day, Tom, is going to be what we're seeing in Japanese yields. And there's, it's not going to be easy actually for Governor Kuroda. I wonder whether they're not too distraught about that because he's leaving in 2023.
Yeah.
And so you could reposition the Bank of Japan.
You've sat down with him a number of times. Yield curve control and whether they step in. Careful with
This
the
almost,
espresso.
I know. See, I get
excitement.
excited so much about central banks that we spill the espresso. Please don't do that.
We're going to get more on all of this. And market reaction with Virginie Maisonneuve, Allianz Global Investors, Global Equities CIO, on inflation, monetary policy, and tech earnings. Hold on to your espressos. That is next. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Welcome back to the Open. We are 15 minutes into the European trading day. Gains across the benchmark European Stock 600 of 0.3%. The future stateside, the S&P E-minis pointing to gains of 1%. Similar picture, in fact, a stronger picture for the Nasdaq 100 on the back of a pretty disastrous day yesterday. But of course, in late trade, Amazon picking things up. Currently, Nasdaq futures pointing to gains of 2%. And across your sectors here in Europe, energy and construction, basic resources leading. WTI breaking above $90 a barrel for the first time since 2014. Francine.
Now, central banks almost everywhere becoming more hawkish. On Thursday, the Bank of England raised rates by 0.25 percentage point, but came within a whisker of a 50 basis point hike. ECB President Christine Lagarde also said the risks of inflation accelerating have increased, and here's what they had to say.
Compared with our expectations in December, risks to the inflation outlook are tilted to the upside, particularly in the near term.
We have not raised interest rates today because the economy is roaring away. An increase in bank rate is necessary because it is unlikely that inflation will return to target without it.
I think there was also a concern and a determination around the table not to rush into decision unless we had proper and thorough assessment based on data.
It would be a mistake to extrapolate simplistically from what we have done today and assume that rates are now on an inevitable long march upwards.
The critical one, there are many other ones, but the critical one has to do with the labour market. There was a lot of non-UK labour force that eventually had to leave the United Kingdom, which has not been totally replaced, and where the shortage of work is actually having a bearing on the forces of the labour market in the UK.
Yeah, yesterday was such a big central bank day, and then of course I had that conversation with Mr. Bailey of the Bank of England, and we tried to game theory about exactly how he was seeing interest rates develop. He wouldn't bite too much. But this is, without a doubt, Tom, my chart of the hour. And let's look at Japanese yields, because this encapsulates everything that we're seeing in Europe, in the US, and also here in the UK. They turned positive for the first time since 2016. So if we have that chart, let's bring it up, because it really encapsulates some of the concerns across the world that markets are pricing in. So the yield on the 5-year government bond this week hitting zero for the first time since 2016, actually January of that year, where officials announced a negative interest rate strategy. And the question is now that basically investors are betting that BOJ will eventually follow some of their overseas peers in tightening policy. I don't know how much of a concern that is for Japan. So joining us to discuss all of this, Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors. Virginie, thank you so much for joining us. There is a clear move to hawkishness. Investors really pricing in some quite aggressive moves across the board from every central bank. Is there a world that there's a groupthink concern that actually then doesn't come to fruition?
Well, I mean, the way I look at it is it could be a transitory hawkish moment. The reality is that we have new factors such as Ukraine, oil prices, inflationary pressures from that end, if you want, along with employment pictures that around the world are much better. At the same time, we know that sometimes in Q2, Q3, we're going to have the base effect, post-COVID base effect, as global supply chain hopefully ease off. And that those two, if you want, dynamic forces are creating an environment that's quite tricky. But because inflation is both a phenomenon from the past and from the future through inflation expectations, it's important that central banks put a line in the sand, if you want, in order to prepare for the second half.
And those lines are now being drawn, aren't they, across the central banking space? The PBOC, the one standout, of course, supporting the Chinese economy amidst the slowdown there and cutting rates. But in terms of the liquidity adjustment more broadly, how are asset markets going to be adjusting to reduce liquidity? Particularly, you've got the rate rises, of course, but also the action around the balance sheets, the BOE, and particularly the Fed.
Yes, exactly. And I think that's really, really important to notice that, because if you put tapering and rate increase, you're creating a picture that could be quite dramatic. But at the same time, we know that this slowdown is likely to come in the second half, and inflation is likely to be slower as well. So it's a very strong balancing act. It requires a lot of agility and probably will create more volatility in the market, although the normalization, if you want, I think is a good message overall for the global economy.
Virginie, there's something that struck me actually on Deutsche Bank, and their head of FX, George Servelos, has changed his view on euro. And I never really thought that this was going on. He just sent a note saying, look, their pivot towards a bullish euro dollar following the ECB press conference may seem quick, but basically thinks that, they have in the last 10 years really emphasized the need to move. And this is the time that actually you reprice a lot of the currencies. Did you reprice anything after those two press conferences yesterday?
Well, I think you have to look at it in the short term and the longer term. Clearly, we know that this is a surprise factor, that Europe is moving a little bit further or faster than anticipated. And Christine Lagarde made the point very clear on employment and energy, etc. But at the same time, so that's the big surprise. And of course, that's going to support the euro. If you go beyond that, you'll probably get higher yields in the US relative nominal terms relative to Europe faster. And so I believe we're going to see this sort of volatile exchange rate based on that, if you want, sequencing of normalization.
Okay, Virginie Maisonneuve, Global Equity CIO at Allianz Global Investors, stays with us. We'll get some of her calls after the break. How to position within these markets. Francine.
Yeah, it was amazing, actually. Again, to just hear a lot of the banks and our own Bloomberg Economics reshifting after what they saw as a much more hawkish Christine Lagarde. Coming up later in the program, the Bank of England was inches away from an unprecedented 50 basis point hike. We'll hear from the governor, Andrew Bailey. We caught up yesterday, and of course, we'll talk about whether you can also ask for a wage increase. I mean, it's really got everyone talking in the UK. Those were probably comments that the Bank of England will live to regret. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Welcome back to the European Market Open. Still with us is Virginie Maisonneuve, Global Equity CIO at Allianz Global Investors. Virginie, what are you making, what lessons are you taking from the divergence that we're seeing in mega cap US tech and how it informs your investment decisions within that space?
Yeah, I like that. I like the differentiation because it gives really stock pickers an edge, if you want. I think as tech permeates the global economy and all sectors, and as digital Darwinism, if you want, competitiveness around tech takes hold, you will see more of those differentiation. And we still like the infra side, the Web 3.0, and if you want, the whole digitalization of the economy. We think there's some very strong names there.
Virginie, given what happened with Meta, is it too soon to actually bet on the metaverse? So, you know, they made a big bet spending $10 billion, thinking that it's a good investment, but it could take 4 or 5, even longer to see the fruits of that. What does it mean for an investor?
I think we like the concept around the infrastructure that is needed. I think around the monetization from a consumer standpoint, you know, that you can get from it. Excuse me. So, but you can play it through suppliers as opposed to through companies who believe they are creating the metaverse, if you want.
Okay, Virginie Maisonneuve, Global Equity CIO at Allianz Global Investors. Thank you for those insights as ever. Coming up, the Bank of England was inches away for an unprecedented 50 basis point hike. we're going to get Francine's interview with the governor. Stay with us. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. 30 minutes into European trading day, and here are your top stories. Amazon delivers strong results from the e-commerce giant, helped stem the rout in tech stocks. Today's market catalyst, non-farm payrolls. The Hawks have it. Well, the BOE hikes with 4 of 9 officials pushing for an even bigger increase, while at the ECB, Christine Lagarde no longer rules out raising rates this year. Plus, on the brink, the crisis engulfing Boris Johnson's government deepens as 4 top aides to the Prime Minister resign. Tom, if you look at the markets, so the bets actually on a hawkish, central bank environment across the world, also impacting Japanese yields, that 5-year positive for the first time since 2016, but also a liftoff thanks to Amazon and some of the tech stocks.
Yeah, it's not hyperbole to talk about what an historic day it was for the central banks yesterday as you sat down with the BOE governor and adjusting to that rate rise, of course, and the 2 consecutive rate rises from the BOE. That's historic. Haven't seen that since 2004. And then, of course, that split within the voter group and the members looking, it seems, to another rate hike next month. In terms of the gains that we had seen across the European Stock 600, they've been paired. As you can see, we're now range bound, so adjusting to some of the monetary policy action, but also the earnings picture as well. So Amazon came out with a very strong beat, putting to bed some of the concerns about the broader tech sector, which has been ignited by the mess that was Meta. In terms of DAX, that is currently down 0.4%. You're getting some divergence across the main indexes here in Europe this Friday, up 0.3% for the CAC 40, and gains, thanks to basic resources largely, but also energy financials of 0.6% for the FTSE 100. Let's switch it on and see how things then are breaking down across the different sectors. We'll get onto the yield story because we've seen a tick up in those yields, particularly the German bunds, but also gilts here as well. Again, markets readjusting the pricing around more hawkish central banks. Energy is gaining almost 2%, 1.6%. Media is up by 0.4%. Most other sectors, though, in the red, but it's a bit of a flat day, essentially, across the space here. Just 30 minutes into the trading session, chemicals and autos down by 0.6 to 0.9%. We saw the gains in euro dollar yesterday, and then that readjustment to the more hawkish commentary. In terms of what's happening in the yield space, we mentioned this then. The 5-year German bunds breaking into positive territory, those yields, for the first time since 2018, as we heard that hawkish commentary from Christine Lagarde. So we're going to get into that conversation with Stephen Major in just the next few seconds. Francine.
Yeah, Tom, the problem is that, they were hawkish, but without great conviction, or certainly not as much conviction as the Fed. And when you speak to, for example, Bank of England officials, they seem to say, look, yes, we'll have to raise, but it'll be gradual. So you also wonder whether they want to see the effects, not only of inflation, but some of the other things, maybe what the Fed is doing. So 40 basis points for the ECB is being priced in by the markets by the end of the year. 1% for the UK, for the BOE by May, but it is a conundrum, particularly, arguably, more so for the Bank of England, given the pressures around wages, around energy costs, a slightly different scenario that you have versus the Eurozone. You could make that argument that ultimately it's a more difficult picture for the Bank of England. But again, we can get that call from Stephen Major of HSBC. I know, the interview of the day, the Bank of England raising a key rate policy, of course, at 0.5%, with the governor voting with the 5-4 majority for a 1/4 point increase. Now, Governor Bailey told us that he favored moving interest rates gradually instead of delivering an unexpected shock to get inflation under control.
I think it is likely that we will raise rates again. I think it's more likely than not. I would say that, however, please, when I say that, don't overinterpret it. There are, I think, good reasons in our forecasts and our reports suggest that we will see inflation. We will see inflation come off. We will see demand growth start to weaken. And that, particularly depending on the prices, on the path of energy prices, that we might see something faster and better than we expect. So there's a lot of uncertainty around, and that's that's for me is the key point in the question. For me, it was a question saying, I think it makes sense to move in a step of 25 basis points. We've then got a period of time to assess that.
The market is pricing in interest rates at 1% by May. Are they right?
Well, my view very much is we've moved by 25. We're going to now take stock. I don't have any number in my head for March or May, so we will take stock. Now, what I would say to the markets is, look, you have to form a view based on what you're observing, what you're observing in terms of the economy, just as we do.
But are they off the mark, or could they be in line with expectations?
Well, we're going to take another view in March.
Of course. Governor, your balance sheet is set to be around 220 billion smaller by the end of 2025, even before thinking, of course, about sales. So do you have an idea of where the terminal size it would be in your mind?
That's a very, very good question. And we don't, actually, in the sense that we don't have a figure. We have no real experience on this front, and we're going to have to find our way. And the reason is that clearly, we're talking about what is the sort of, in a sense, the level of the steady state level of central bank reserves in the system. Now, there are two sort of bookmarks, if you like. There's what it is today, where I would say, it's higher than the steady state. There's what it was before the financial crisis, before we started the quantitative easing path, when it was very low. And of course, it was not necessarily low from a monetary policy point of view. Critically, it was low from a financial stability point of view. And clearly, the system needs more reserves. We've changed liquidity regulation for banks. Banks have a greater demand for reserves on that basis. So it's clearly higher.
Well, that was Bank of England Governor Andrew Bailey speaking to me yesterday. Now, we'll also be speaking exclusively to the Bank of England chief economist, Hugh Pill. That's a little bit later today, a conversation on inflation, of course, on wages, and maybe whether people need to ask for a pay rise or not. Don't miss that exclusive interview at 10:30 a.m. UK time. Now, to talk about gilts, to talk about sterling, and of course, what we heard from the Bank of England, we're delighted to be joined by Stephen Major of HSBC, Global Head of Fixed Income Research. Stephen, great to have you on the program. When you look at some of what the gilt traders want to know, it's really what kind of effect QT has. Was this overlooked yesterday, and could we see a taper tantrum on the back of it?
Yeah, well, QT is going to happen now because they've reached the 50 basis point threshold. I think the market's really concerned about how the asset sales are going to work. And Mr. Bailey was quite candid that they're feeling their way. There's going to be a consultation, I guess, with the market because this is new. Actually selling bonds out of the portfolio is a new thing. So that's quite controversial potentially for the gilt market, especially given how the curve sits flat compared to its global peers. Apparently, if and when they reach 1% on the bank rate, and as Mr. Bailey said, it's conditional on the data, and it's a long way away, it's 2 more hikes away. If and when they reach 1%, they're going to consider the sales of the gilts. I don't think QT, which is a passive policy, allowing a natural runoff, I don't think that's a big deal. That's been expected for some time, and the market can take that in its stride. I think it's largely signaled in advance.
And it's those corporate bonds that they'll be running off first, Stephen. So does that have a read across to the corporate credit space in the UK? How should corporate credit investors in this space be thinking about that?
It's a small amount of bonds compared to the gilts, and it's been put to me that was a surprise that they'd want to sell the corporates out. I don't see how it can be a surprise, because if the central banks are moving to some sense of normality, they shouldn't have credit on their books. And if they go back to business as usual, they're going to manage the amount of reserves, and they're going to use gilts in part of the open market operations. And there's no role for the credit in the portfolio, so it needs to go. So to me, that shouldn't have been a big surprise. And there's going to be some ready buyers for some of those names, because part of the challenge in euro sterling credit is that there's a lack of bonds. And it mainly trades through the primary. So some investors are going to be quite keen to pick up some of those bonds.
So, Stephen, we could be looking at, the fastest tightening since 1997. The market's pricing in 1% interest rate in May, and then we could see 1.5% by the end of the year. What kind of timeline are you looking at?
Well, I don't know whether it will get as high as that, Francine. It's path dependent. I hate to say this, but just imagine what the world's going to look like in June. So what happens if inflation is falling dramatically at this point? And what happens if unemployment is going up? It could well be a completely different set of conditions. And that's just talking about the UK. What about the global read across? What's happening in China? China is the last one to be easing, it seems, at the moment. So there's a big global story, and the local story is going to change rapidly. So I think 1% is already a long way away from where we are now. 1% is the key line in the sand because the bank has made it so. The bank has said that's the threshold where they're going to consult on the selling down of the gilt portfolio.
Stephen, how are you thinking about sterling at this point? Does the fragility around the UK economy offset that higher path of rates in terms of the pound? You turn bearish on sterling?
Well, it seems at times like this, the FX market starts to reach for the old-fashioned research method, which is to look at rate differentials. And so sterling seems to have done all right on the back of that. So it quite likes the rates going up. But a more considered opinion would recognize that throughout history, sterling has sometimes been a tool of policy. So if the UK has a really high inflation rate, and there's this question of the falling potential GDP, which is a function of Brexit from a few years ago, then maybe the rates can't go up very much. And in that case, the heat needs to be taken out, maybe through sterling, maybe through the shape of the curve. And so I think the Bank of England is fully aware of this. In some ways, sterling is part of the tools of monetary policy here. So it may enjoy the rate differentials, but that's really a temporary thing.
Stephen, one of the most interesting market moves that we also, saw today was basically the 5-year yield in Japan turning positive for the first time since 2016. I mean, this could lead to a global repricing of bonds across the world. Are they getting too ahead of themselves? As you say, the world could look very different in June of this year.
Yeah. So these markets are all connected. The cheapest part of the US curve is the 5-year. When you're in a tightening trend, the part of the curve that moves the fastest is the so-called belly. So the 5-year leads, and you've got multi-decade cheapness in 5 years in the US. So it's logical that if the probability that the Bank of Japan policy is going to change, and it's similar with the ECB and with the Bank of England, it's the 5-year that tends to lead this move out. So that's quite logical. But I don't know whether the Bank of Japan is ready to start hiking rates yet. I think that's a long way off. But again, markets are in sort of risk management mode, and they're looking at the probabilities for later this year and next year.
Okay, risk management mode for these markets. Steve Major of HSBC, Global Head of Fixed Income Research, stays with us. And coming up later on the show, the crisis surrounding UK Prime Minister Boris Johnson deepens. We said that before, haven't we? But it really is. Following the resignation of 4 aides. That story later in the show. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open. 45 minutes into the European trading day, we look at technology stocks. So bonds under pressure because of what we saw from both the Bank of England and the ECB. Also, the move is impacting, yields in Japan with the 5-year actually for the first time positive since 2016. European stocks down some 0.2%. I think they've shifted a little bit, and we're seeing a bit more pressure on some. So energy and technology still up, but a bit more pressure on some of the staples. And again, we're just in the middle of earnings season.
Okay, let's get back to Stephen Major of HSBC, Global Head of Fixed Income Research, who is still with us. Stephen, feel free to shoot me down at this point, but can I posit that maybe Europe is in a sweet spot? If they have the APP program still running, they're going to stop PEP in March, 40 basis points priced in by the end of this year, okay, shock horror. Yes, we've readjusted to a more hawkish rhetoric from Christine Lagarde, but compared to the other central banks, and the inflationary pressures that are different here, the wage prices are not there in Europe. Energy is a problem, but if you look through all of that, is Europe in a sweet spot?
Yeah, I'm not going to shoot you down. Okay, first thing, and I think I would agree with a large part of that. Many people will look at the forward guidance, and that's what's really driven their forecast. And so that's why people were forecasting 2023 for the first hike. Maybe something's going to change. So we'll look at some of the speeches that are going to come up, so that may slowly get rowed back to make it possible. But you're quite right. There isn't really the kind of inflation problem that they should worry about. There is a big, juicy headline number, but wages are not spiraling upwards. And I think the ECB can take its time. But I said it on the earlier segment, there's this thing called risk management, and it's about longer run credibility. If you like, a stitch in time saves 9. So go for a small hike at some stage. It could be later this year or next year. I mean, our forecast has always been 2023, by the way. But a small rate hike may save the need to go much more later. And that's how I see it, really, is that markets are probably quite pleased that central banks are getting on with it. But it doesn't change the fact that when they hike, they're not going to get very far. And the rate that they end up with, the terminal rate, is going to be lower than the previous cycle.
But, Stephen, what I don't really 100% have a grasp on is actually wage growth. So if you see the projections of the Bank of England, they're at 1.5% in November, and suddenly they're 3 times higher. So I know we're also, dealing with Brexit and labour shortages in the UK, but could we see a similar pattern in the Eurozone, where actually suddenly wage growth hits hard?
Well, in the Eurozone, we've got data from late last year. In Germany, for example, there was no evidence of wage increases to worry about. And in fact, whilst the key unions may have pitched for anything between 4 and 6%, they settled for 2 to 3%. So given productivity, that wasn't inflationary. And in fact, this was a good example of rational expectations. Workers are thinking, if we ask for too much, we might end up losing our job, and it could go to someone else in the Czech Republic, or we'll lose market share to Korea or Japan or China. So workers are quite rational. In the UK, and Madame Lagarde pointed this out in her press conference, there's a lack of labour. Many people have left the country, and we're now feeling the impact of Brexit. So as I said before, it's likely that the potential GDP in the UK is lower than it was projected to be before Brexit, and there's less people to do the work. So it does seem that wages are a concern for the Bank of England, and trying to nip inflation in the bud is going to help in terms of the real disposable income.
Just very quickly before we let you go, your calls. You like China sovereign still, and South Africa?
Yeah, so we haven't really changed much in terms of forecast. The benchmark forecast is the Treasuries, which we think will yield 1.5 by year end. Obviously, it's going slightly against us right now, but the year is still young. Some of the EM markets, led by South Africa, look very interesting now that their real rates are so high compared to their equilibrium. And China, we think, is still easing, and that has been a win-win market now for about 15 months. So that trend, I think, is still in place.
Stephen, thanks so much. As always, Stephen Major there of HSBC, Global Head of Fixed Income Research. Coming up, the crisis surrounding the British Prime Minister, Boris Johnson, deepens following the resignation of 4 aides. We'll have that story next, and whether the Prime Minister can hold on to power. This is Bloomberg.
Rising energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 53 minutes into your European trading day. Happy Friday. The market's turning around here in Europe, currently down 0.3%. The one standout is the FTSE 100 up 0.4%. Propelled by energy and banks. Every other sector, by the way, in the red. Yields just coming off a little, but your 5-year German Bund breaking into positive territory in terms of yields for the first time since 2018. Currently, euro-dollar at 1.14, sterling at 1.35. Technology, as well as the central banks that we've been breaking down there with Stephen Major of HSBC. Technology, just remarkable what's happening with Meta. And then Amazon just really killing it with AWS, with advertising, and with that boost in subscription payments.
Yeah, Tom, I absolutely loved your chart, actually looking at some of the valuations and really comparing some of the big names that we're talking about. So we know TikTok is doing very well, and that's thanks to the short videos. Tom and I will be on it shortly. But this goes really to the fact that if you look at Amazon, it's really showing the Meta platforms how it's done. And if you look at the post-trade increase in their stocks, and it seems like they're killing it at the moment.
That more diversified business proposition. And Mark Zuckerberg telling his team overnight, you've got to focus on video. So clearly they want to take the fight back to TikTok for the moment. They're challenged.
Yeah, I like the Reels on Instagram. It doesn't quite cut, the TikTok funny stuff, but it's quite good.
They're
now, the
very
crisis, we should get number 10 on TikTok. The crisis surrounding the embattled UK Prime Minister Boris Johnson deepening following the resignation of a long-standing aide. Now, she left in protest over an accusation Johnson made in Parliament about opposition Labour leader Keir Starmer. Well, joining us now is Bloomberg's David Merritt, who heads our EMEA news desk. David, first of all, it was basically 4 aides and one of his closest aides. Can he actually survive this?
There are 4 senior jobs at Downing Street which are vacant. I think you're right to zero in on Munira Mirza. She's been by his side for about 14 years, way back to when he was mayor of London, and has been hugely influential in his entire career. For her to actually decide she can no longer defend him, work with him, that really sent shockwaves around Westminster last night, and there is a bit of a sense of the sand shifting here, and we're on high alert now for who else is going to go. Number 10 trying to spin it, of course, last night, saying, well, this is all just part of the clear out. Remember the Prime Minister promising when he made his apology earlier in the week, he was going to restructure 10 Downing Street, going to bring in new people. But I don't think he ever intended it to be his closest aide who would be leaving.
And it looked fairly coordinated between the 4. What are we watching for next? What is the next tipping point?
Yeah, there are reports of more people from Downing Street leaving this morning, unconfirmed as yet. But of course, the real key here will be someone from the cabinet, someone from the government. We had Rishi Sunak, the Chancellor, yesterday. It wasn't exactly an attack on the Prime Minister, but he did say something like, I wouldn't have used those words. Now, coming from the Chancellor, that's actually quite a change in position. It's not a ringing endorsement. He's not defending what the Prime Minister said. That is a shift. So let's keep our eyes peeled for someone of that stature deciding that they themselves can no longer actually defend this prime minister. And then, of course, there's this famous count of the letters, aren't there? You know, the 54 magic number of no confidence letters that need to go in order to trigger a confidence vote. There may well be more of those happening, but no one knows the real number there.
David, thanks so much. David Merritt, of course, who heads our EMEA news desk. Just also Eurasia coming up with a new note, Ms. Rahman saying that now the chaos at number 10 means that he has reinforced the 75% odds of Johnson leaving this year.
Fascinating. Keeping an eye on that. Stay with us. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
It would be a mistake to extrapolate that rates are now on an inevitable long march upwards.
Risks to the inflation outlook are tilted to the upside, particularly in the near term.
I think it is likely that, we will raise rates again.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. A hawkish course from Christine Lagarde and Andrew Bailey hurts bonds. Traders bet that the ECB will end negative rates this year. Amazon delivers, while strong results from the e-commerce giant help stem the rout in tech stocks. Today's market catalyst, non-farm payrolls. Plus, 4 senior aides to Boris Johnson resign from number 10. The pressure on the Prime Minister grows. Now, first thing is first, and there is quite a lot going on in markets. Now, it's a tale of being pulled on 2 sides. First of all, we had some pretty good results from Amazon, and that is definitely a cushion for investors that worry about what the central banks are doing with that tilt becoming much more hawkish. hawkish. You can see yields on the move after the ECB president changed her stance, or certainly indicated, because of pressure from the hawkish members on the ECB Council, that she needs to at least indicate that there could be an interest rates rise. Money markets now pricing in something for this year. German 5-year actually pretty much flat, but we're seeing definitely a flattening yield curve that started with the Fed being hawkish. One of the most interesting things, it's not only what we're seeing, for example, for the Bank of England, and we have a great interview coming up, an exclusive interview with the chief economist of the Bank of England, that 10-year yield at 1.38. But overall, it's really going overseas with Japanese yields also taking a hit as traders bet more and more that there is going to be something for them as well. So if you look at the Japanese 5-year yield above 0% for the first time since 2016, that is the first time that the Bank of Japan was talking about going to negative territory, and this is as investors price in more and more the hawkish stance also going to Japan. As Stephen Major of HSBC was reminding us, everything is linked. Now, Amazon capping a rocky week for tech with earnings that beat, sending its stock soaring as much as 19% in late trading. Profit beat expectations thanks to its cloud services, and investors cheering a Prime membership price hike. Snapchat and Pinterest also jumping after hours. Meanwhile, yesterday's U.S. session saw $251 billion wiped off Meta's market value, the biggest in history. Now, for more on the tech sector, we're joined by Matt Bloxham, our senior tech analyst at Bloomberg Intelligence, and Christine Aquino, who's our markets editor. So thank you both for joining us. Matt, I mean, it was quite amazing, actually, looking at Amazon and the difference that Amazon is doing compared to Meta. Is it just because of the various products that they're doing? One is based on cloud, and actually the other one is just on, you know, the non-video social media.
Yeah, that's right. I mean, Amazon's a very diversified business, you know, retail, online, advertising, and cloud, whereas Facebook, pure play advertising, and it's, you know, facing big headwinds with the technology change, TikTok really eating some of their lunch, and also those Apple changes to ad tracking also creating some headwinds. So, you know, a real slowdown in sales growth expected at Meta in Q1, whereas Amazon's still pushing ahead. Their cloud business is still growing at 40%, 30% profit margin, and their ad businesses, you know, growing at 30%. So yeah, quite different businesses.
Matt, but pre-markets, I mean, Snap is rising 55%. I mean, talk about being on a tear. So Snap rising 55% as a sales forecast beat estimates. Amazon gaining some 13%. I mean, it's absolutely incredible. And it really goes to the fact that if you're an investor today and you're a trader, Christine, you kind of think, right, there's the central banks are very hawkish. That makes me worried about the future of liquidity and what it means for my portfolio. And then so you're trying to grapple at earnings to see whether they're better than expected, which is why Amazon gave a lift to the market overall.
Absolutely, Francine. Again, it's really about fundamentals now instead of froth, which has been the big story in tech over the last couple of years, you know, and especially even through the pandemic years. But now that we're kind of moving away from that and we're in this broader environment of higher yields, tighter monetary policy, it really is going to be all about the fundamentals for these companies and whether they have a unique stand out from the rest of the pack. And yeah, the theme really is going to be differentiation with the asymmetric risk. We've been talking about this all week in terms of how investors are really looking at earnings and punishing those that really cannot deliver and rewarding those that really can. I think, you know, the divergence between Amazon and Meta's results tell that story perfectly.
Matt, I have a couple of morning must-reads, actually one that we'll bring up in a second, but there's also something by Richard Windsor who says, you know, Amazon was great, but he says it could easily slip back into its bad old habits of constantly losing money on e-commerce. Why are we suddenly so bullish on Amazon?
Well, I mean, it could have been a different print for them, and this price increase on Amazon Prime really helped them out. But yeah, I mean, for sure, you know, you've had to be have a very long-term view as an Amazon shareholder because they consistently plow money back into that e-commerce platform. You know, billions and billions of extra dollars through the pandemic to improve service and safeguarding for their own employees. I don't think that's going to change. It's always going to be a long-term play. They are investing for the next decade, not the next 10 weeks, essentially.
I know it's all about social media. This is one of my morning must-reads. It's a really fun story, if we can bring that up, and it really goes to the heart of the matter that if you're you know, on Facebook, then less people are interested in it, but also if you're, for example, on Instagram, it's more difficult to access the cool videos like you're on TikTok. Matt, the TikTok millennial. Facebook needs to solve its TikTok problem, says and writes Tae Kim. The social media giant has been caught unprepared by the growing popularity of short-form video. I mean, can they come back from that?
They can, but it's hard. I mean, if you think about the playbook historically, it's been about to buy nascent businesses that take them into the next big thing, and they're going to find that much harder now with all the antitrust scrutiny on them. So I think they're going to have to work harder organically. They've not had a great track record on that. They've got Reels, which is this Instagram rival to TikTok. They said they're pleased with progress, but it's nowhere near prime time yet. So it's got a long way to go. And who knows, by the time it's in prime time, maybe the next big thing will have come around and it'll be too late.
I mean, I love Reels. It's just usually less funny than TikTok, right? You just use it for different things.
That's right, yeah. People are already in the TikTok. Yeah, they spent the pandemic getting their heads around how to be a great TikTok content producer, and now you've got this new thing, and maybe with people back at work, they won't have the time to invest in becoming a Reels expert too.
I know. I mean, I'm not funny. I wish I was funnier just to be on TikTok. What does it mean for markets, Christine? So, you know, next week, or maybe not next week, next week we have a lot of earnings. I think we still have like 200 companies reporting, but the week after, is it going to be just a shift going back to central banks, and that's the only thing the markets will care about?
Well, Francine, yeah, I think that will be overarching story here, even as investors will turn to the earnings season and more of the companies reporting next week. I think they will still have in the back of their minds, how does this fit into the broader macro picture? And especially now, after what we saw from the BOE and ECB yesterday, really this idea of a potentially much bigger rate hike being delivered by these major central banks than perhaps investors were expecting. That's a very real possibility now. And, you know, coming into the start of this week, the idea of a Fed 50 basis point rate hike perhaps was fading into the background a little bit. I think that's very much, again, on the table for discussion now that the BOE especially brought that back into the realm of possibility for investors.
I mean, this is a great chart looking at how tech diverges, actually looking at Meta, Alphabet, and Amazon eyeing that 14% gain in pre-market, now 13% as it's reopening up. Have you tried Oculus? I mean, the Oculus app, which I really need to get my hands on, I think was #1 in the Apple store chart, which is, you know, which means that people are gifting it quite a lot.
That's right, yeah. I mean, I've only used it in trials, you know, when you go to these investor days, so I don't have my own personal headset, but yeah, no, it's pretty cool, and it's that, you know, that whole area is really developing quickly.
But so if you're investing 10 billion, I'm thinking about Meta in the metaverse, when do you reap the rewards?
Well, probably not for a good many years, to be honest, yeah.
And that's the main concern, right?
I think that's right, yeah, and it's almost pockets. You know, obviously gaming has been really hot recently, so you definitely would have reaped some rewards as an investor in gaming, and that's arguably what defines the metaverse now. So you need to pick those next pockets that are going to define the next generation of the metaverse.
Matt, happy Friday. I have a good loaded question from a viewer for you. Thank you, Anthony, for writing in, saying, is Trump's upcoming launch of his social media platform a potential risk unpriced, and is it a new risk for Facebook? Discuss.
Yeah, I don't think so, to be honest. I mean, you know, it is potentially going to raise all these issues around, you know, content screening and who's responsible for moderating content, but I don't see it as a threat to the meta universe, if you like.
Matt, thank you so much. Happy Friday, everyone. Matt Bloxham, our senior tech analyst at Bloomberg Intelligence, and our Christina Aquino, our markets editor. Now, coming up, we'll hear from Governor Andrew Bailey on why he prefers more gradual moves in UK rates. That's our interview. It's coming up shortly, and this is Bloomberg.
Has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of England was inches away from making a 50 basis point hike yesterday, but the deciding voter, Governor Andrew Bailey, said he favored moving rates gradually to get inflation under control. Well, here's more of what he said when we sat down with him yesterday.
I think it is likely that we will raise rates again. I think that's more likely than not. I would say that, however, please, when I say that, don't overinterpret it. There are, I think good reasons in our forecasts and our reports suggest that we will see inflation. We will see inflation come off. We will see demand growth start to weaken.
Well, joining us now is Mimi Rushton, a co-head of global FX sales at Barclays. Mimi, thank you so much for joining us. What we heard from the Bank of England is that they want to play it safe, or at least the governor does, because he doesn't really know how inflation will pan out. Do you believe that we'll see 1% interest rate hikes by May, just like the market is pricing?
Thank you so much for having me. As you quite rightly mentioned, we were a whisker away from seeing 50 basis points increase just yesterday. But currently, our expectation is that we will see another 2 hikes, potentially one in March and then one in May. But at that point, really, the Bank of England will potentially be looking at a pause and looking at the data. Here, the issue is multifaceted. And I think Governor Andrew Bailey made a really good point around the fact that, it is not an easy economic recovery that we're looking at. The UK is far from booming. There are inflation considerations that are incredibly complex because it's less about a demand-driven recovery, and there are supply-side issues that are to take into consideration. So our view is less aggressive than the market is currently pricing, albeit it is completely understandable that the market is now pricing in more interest rate increases, given how close we were to seeing that 50 basis points yesterday.
But do you think the market now actually thinks that, they're behind the curve? And you could argue that had they done something in November, like the market was priced in to absorb, then we would be in much better shape today.
Yeah, it's really difficult. I think that, hindsight is always 20/20, and Governor Bailey took his criticism in November about the fact that we hadn't necessarily seen that rise earlier. But you've seen this level of caution from all of the central banks, and they really do want to wait for that data and not necessarily stem the economic recovery that they're hoping for as we emerge out of the pandemic. What's interesting, though, anecdotally, what we hear from our clients is that this picture is as complex as the central banks are describing. And perhaps, that persistence of inflation is going to be something that the banks are going to have to catch up with. For example, we've talked a lot about supply chain issues into 2021, and you've seen that in some of the corporate earnings into 2022, guiding around that. If that does persist, there's an argument that perhaps the bank should have gone a little bit earlier to try and sort of help stem that. But the supply chain issues aren't going to be solved by monetary policy on their own. There are broader impacts, such as, for example, the policy in China around, around zero Omicron cases and zero COVID cases, which makes this very difficult for the central banks to try and control just themselves. So the idea of having some caution in their monetary policy, but also having flexibility, which I think, frankly, we heard from both Bailey and Lagarde yesterday. It just means that that's kind of the path that we're in, and we're going to be watching that data very, very closely. And incidentally, it's been something that the Fed have flagged clearly, but it's just that we're now doing it with a broader set of central banks.
Yeah. Yeah, and it's also impacting, of course, Japan. Everything's linked. Mimi, let me go back to the chart that we were just showing on TV, looking at the 2-year yield. When you look at gilts, I mean, it's amazing the repricing that they've had, I think, over the last 14 months or so. Just a year ago, they were negative. They're now at, just over 1.14%. Where do you want to be in the curve right now?
Sorry, I didn't hear the start of your question, Francine. I apologize. Would you mind repeating it?
Yeah, we're just looking at the 2-year. I love, Mimi, that actually you're in a working trading floor and that we're hearing all the noise. So thank you for bearing with us. It's so nice after a 2-year hiatus in the pandemic. I know, it must be fun, right? Traders are back at the desk.
Yeah.
I was asking about yields and gilts and where you see the most attractive space in the yield curve right now.
So I think it's a difficult one to call for the reasons that we described. In that, on the one hand, we see that there is the potential for further interest rate increases, particularly during the course of 2022. But there's probably some value in sort of that 1 to 2 year space that still remains. What our clients are telling us around some of these challenges that they see around the persistence of inflation do come to pass, and we see that actually the central banks need to take more action. But I think it's far from certain, and actually, the repricing that we're seeing in some of these curves in the last couple of days speaks to that level of uncertainty, but also how we haven't necessarily had that positioning in non-US central banks. But you're right, by the way. I love the fact that the trading floor is back up and running. It just doesn't necessarily help me in hearing you.
I know, but it's nice to be back, and it's nice they must have had a hell of a ride yesterday with the ECB and the Bank of England talking about the ECB. So it's very clear that traders, Mimi, were accelerating some of the bets on policy tightening, and then now we have a ECB governing council member, Mueller, coming out and saying that they may review how quickly they will end their bond buying program. What sequencing are you expecting from ECB?
I actually think that Christine's saying that there needs to be the end of the quantitative easing program and bond buying, bond asset purchasing before we see any rate increases. And there was nothing in yesterday's press conference that should lead us to think otherwise, albeit that it's always interesting to hear from commentators after the event. The ECB and their turn to a hawkish tone was really interesting in that the market wasn't by and large expecting it, and we saw that in the price reaction. We saw that in FX. And if you look at what happened in price action there, since the start of the week, we've seen about 2.5% increase in the euro. Euros are typically used as a funder for many asset managers and investors when they're thinking about how to fund broader purchases. That position now has to change, and we're starting to see people buying the euro, starting to believe in the fact that we might see a more hawkish ECB first, and then ultimately those interest rate increases. Now, the market is pricing interest rate increases for this year. That's not our view. Our view still is that we see that wind down of the asset purchase program first, and then we see rate increases in 2023.
Thank you so much, Mimi Rushton there, co-head of Global FX Sales at Barclays. Now, let's also have a look at what some of the pre-market movement in the U.S. is looking like. Amazon gaining some 13% after a blowout set of numbers. Of course, they focused on prime customers and were able to increase their pricing for those. This is what analysts like, and they also did very well on cloud. Snap, wow. I mean, I know this is a stock that's been quite volatile in the last 12 months, but it's gaining some 52%. Coming up, we'll put that into context and have a more historical chart of Snap. Coming up, the crisis surrounding the UK Prime Minister Boris Johnson deepens following the resignation of 4 top aides. That story's up next. This is Bloomberg.
see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
As a company grows, there are more challenges. What do you worry about the most?
Good morning, traders. New order placed for euro, and as I can see, position opened at 114.55.6 because it moved higher. Okay, you still have time to place an order. 114.55.6. I will adjust today's Canadian dollar. We had a really good trade, as you can see, on euro against United States dollar. We was holding for probably for months, for several months, our positions. Now we closed all positions, and right now we opened new position on euro. Okay, euro, United States dollar. Okay. Okay, and position opened at 114.55.6. I'll speak to you later, guys.
Point to Munira Mirza, though, because she predates his time as Prime Minister. She's been by his side as an advisor right going back to when he was Mayor of London, a hugely significant departure. If somebody is loyal to him, as Munira Mirza, no longer feels that they can defend him in public or even be associated with him, then this is a Prime Minister who really has to be in trouble.
I mean, we need to find out. And first of all, there's a great piece by Mijraman of Eurasia saying that the odds of him leaving, or he is reinforcing his 75% odds of Johnson departing this year. But someone like, his chief policy advisor, is she leaving because she has a moral stance against this and some of the things that he said in Parliament, or is it because, she's unemployable because the Prime Minister will be kicked out?
I mean, she wrote this long letter, which was pretty savage, actually, in its critique, pinning it to these comments around, this slur, accused slur, alleged slur that Boris Johnson used against Keir Starmer. But yes, maybe, she's a political strategist. She can see that the sands are shifting underneath this administration. Does she want to be associated with it for much longer, and decided that actually it's better for her to go?
What happens next? Could we see a cabinet minister resign?
Well, that is the big thing that we have to watch for. We can have aides, we can have political appointees leaving 10 Downing Street. So far, all of the cabinet have fallen into line. We've got backbench MPs calling for him to go, but the cabinet have stayed in line. The killer blow would be one of them coming out. Now, lots of rumours this morning. Is Rishi Sunak sort of on manoeuvres? He had an article yesterday in The Sun laying out his stall. He made a critical comment about the Prime Minister yesterday, something he's not done up to now, all in a very sort of subtle and understated and rather Rishi Sunak sort of way. So is he really on manoeuvres for the top job? We don't know. But anyone in the cabinet, or anyone in the government, in fact, resigning, you could see this continuing to snowball after that.
Yeah, I'd say he's keeping it elegant, but not supporting the Prime Minister, as he used to. Thank you so much, David Merritt. Coming up, we talk about real estate. So we, of course, talk about what is happening to the oldest private equity firm in Europe as well.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A hawkish course from Christine Lagarde and Andrew Bailey hurts bonds. Traders bet that the ECB will end at negative rates this year. Amazon delivers while strong results from the e-commerce giant help stem the rout in tech stocks. Today's market catalyst, non-farm payrolls. And 4 senior aides to Boris Johnson resign from number 10. The pressure on the Prime Minister grows. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's check on the markets, and it's all about technology stocks, and it's also all about the bonds. This is a picture for the German 5-year yield, and we are seeing a lot of moves as there's a pivot towards a more hawkish stance taken by global peers, including the Bank of England and the Federal Reserve. Now, the German bonds tumbling on Friday and pushing that yield on 5-year notes above zero for the first time in over 3 years. Markets really bracing for the European Central Bank to scale back its accommodative monetary policy. And then we saw that briefly, now currently at minus 0.005, so really within a whisker of positivity. This is the picture for the 2-year yield in Germany. So the Bund at the pool, this is one of the most interesting facts. The pool of euro-denominated debt that actually yield less than zero is down more than 70% from a peak in 2020 to just over $2.7 trillion. And you can see the German 2-year yield climbing to the highest since December 2015. On to some of the pre-market moves. One of the big ones that we're watching, of course, which is giving solace to investors that maybe worry about a hawkish central bank environment, is what we're seeing in technology stocks, including Amazon. Amazon gaining some 13%. If it continues to do so by the end of close today, when markets open in the U.S., it means it will add some $200 billion in its valuation. And then Snap gaining some 50%. Again, it's a tale of two cities. Amazon earnings really giving a lift to some of the tech-heavy NASDAQ when traders looking at stronger earnings instead of worrying about this hawkish course that we heard from key central banks that are hurting bonds. Now, central banks almost everywhere are becoming hawkish, more hawkish. On Thursday, as we were saying, the Bank of England raising rates by 1/4 percentage point. It came within a whisker of a massive 50 basis point hike. Now, the ECB President Christine Lagarde also said the risks of inflation accelerating have increased.
Compared with our expectations in December, risks to the inflation outlook are tilted to the upside, particularly in the near term.
We have not raised interest rates today because the economy is roaring away. An increase in bank rate is necessary because it is unlikely that inflation will return to target without it.
I think there was also a concern and a determination around the table not to rush into decision unless we had proper and thorough assessment based on data.
It would be a mistake to extrapolate simplistically from what we have done today and assume that rates are now on an inevitable long march upwards.
The critical one, there are many other ones, but the critical one has to do with the labour market. There was a lot of non-UK labour force that eventually had to leave the United Kingdom, which has not been totally replaced, and where the shortage of work is actually having a bearing on the forces of the labour market in the UK.
Now, one of Europe's oldest private equity firms, BC Partners, has raised more than $1 billion for its debut real estate fund. The fundraising is part of a broadening effort by BC Partners to differentiate its investment platform. Now, nearly half of the capital has already been deployed across Europe, with investments in post-COVID office assets, digitally managed short-stay apartments, and logistics parks. Now, we're now joined by Stéphane Thériault. He's head of real estate at BC Partners. Stéphane, thank you for joining us. Is now a good time actually to buy into real estate, because we've been at home for so long and we haven't been to the office, that you can pick up stuff quite cheaply?
Well, good morning, Francine. Thanks for having me on the show. Look, I mean, I think for the office market, it's we're definitely talking about the deepest asset class in real estate, and probably the one that right now has the biggest question mark, right? And I think for us the analysis is pretty simple. Technology is basically impacting the way we work, and frankly, the way office has been designed in the past 20, 30 years is obsolete right now. It's not about parking people into buildings, to have access to a computer tied to a cable anymore. Right. But for an office building, it's about really basically providing the workers an environment that is actually better than what they can do at home. And can provide, services that are different from those that we can find at home. So clearly, the formula of office space needs to change. It will change. Some element of work from home will continue, but we think that basically you have a huge investment opportunity in this asset class through transformation, which is also has to be environmental friendly.
So what exactly is your plan? I mean, are you trying to be like a WeWork? I mean, there's so many players already in the space. What do you think you can do better?
Well, I think the services don't have that much barrier to entry, frankly. I think that the real estate is the biggest barrier to entry. Put it this way, the product and the location. So it's still very much, the same hunt for the best products. Real estate is not, a market where things are absolutely perfect. So there are inefficiencies in those markets. We can still, do some, get some good buys. But I think most of the way we're going to make money is not so much by buying cheap yet, but really, frankly, by transforming the assets and drive higher rental growth through a better product. I think there's a huge pent-up demand for, 22nd century product, and that's where it's going to come from. I think companies don't have an affordability issue with office. They just need the right new product, and in real estate, it takes time to build.
So what's your ideal? I mean, I have to say, I'm, sitting in one of the best office buildings in the world. So I hope you actually come and see Bloomberg headquarters in London. I understand that, not everyone has this luxury, Stéphane, but what do you have your eye on? What is it? If you look at the future of space, is it in the city center? Is it an iconic thing that you would want to buy? In the UK, would it be like the Shard or something like that?
No, I think we're going to stay away for quite a while from high-rise buildings because we feel the experience is, other than the views, frankly, the experience is not very collaborative. I think the Bloomberg building is a low-rise building in London, which has got iconic, architecture. I think it's a magnet for talent. It's exactly ahead of its time and the right thing to do. But if you look around the city of London, for instance, you see. A lot of buildings that are just extremely boring and that don't have the kind of common areas, common space and services that are needed. So, yes, we would do more in London. We also believe very much that Paris and Berlin present that kind of opportunity. They're global cities. There's a lot of demand. The markets are deep. And frankly, the demand for the kind of space that you guys live in is still very high. And it's going to take a while before we have an oversupply on the side of the new good office space.
Right. Stefan, I was reading some of the reports, for example, from Real Capital Analytics. Now, they focus on commercial space in the U.S., and they were saying, you know, some of the deals in that U.S. real estate space reached record highs of $809 billion last year, as the market has already rebounded. So are you worried that you could come a little bit late to the game? And is the U.S. market a bit frothy at the moment?
Well, I mean, with BC Partner, we essentially invest in Europe, so I'm less qualified to talk about the U.S. market. But there's certainly huge amounts of capital available for real estate, and I would say for private real estate right now across the spectrum. And you need to differentiate in between, you know, the core money, which is essentially going for yield, which still comes at a significant premium from bonds, right? Because, you know, real estate sits in between equities and bonds in terms of sort of risk profile and income profile. And of course, those have been very, very active. I think the sort of opportunistic side of the office market has been a bit less active in the past couple of years, because you know, the mismatch in between what a risky capital can demand in terms of returns and the price at which those companies are prepared to sell is still at a discrepancy.
Stefan, are you expecting everyone to come back to the office like we did in 2019? Because, you know, depending on who's coming back to the office, then I imagine the kind of real estate, because you're targeting specific industries, will change.
Well, you know, I think it's, I mean, let's face it, if you, and that's one of the reasons why we built this business within BSC Partners, frankly, but if you were to do a poll of the CEOs of companies that are controlled by our, you know, by our firm, which I did a couple of years ago, and were to ask them, you know, how many square meters or square feet do you think you're going to use going forward as a percentage of what you have today? And the answer we got was -25. So I think that, you know, people will come back to the office, but I think the future will command, you know, shared office, you know, a more efficient way to use the space. But also probably I would venture to say that I think some office space is going to get closer to where people live. I think the days of, you know, long commuting, 1 hour, 2 hours, and quite frankly, if you think about it, the people who commute the most are the less compensated. I think there is something to be said about, you know, rethinking your occupational strategy and your location. And frankly, you know, are we at the beginning of some sort of decentralization of office space? Because that's what talent wants. You know, they want decentralized companies. They want, you know, human scale units, whether it's in the U.S. or frankly, on the continent. You know, I probably think that's going to happen. I think that, you know, real estate office has been looked at as a cost center for too long. Now it's become a competitive tool, and I think by listening to what the talent wants, I think it's the best formula for us to make smart investment going forward.
Okay, Stefan, thank you so much. It was a real pleasure to speak to you. Actually, I hope to see you very soon.
Likewise.
Stefan Thériault, their head of real estate at BC Partners, looking at good opportunities in Europe as people head back to work but want something more convivial. Now, coming up, the Bank of England was inches away from an unprecedented 50 basis point hike. We'll hear from Governor Andrew Bailey on why he prefers more gradual moves in UK rates. Don't miss that interview. It's coming up next, and this is Bloomberg.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
I think it is likely that we will raise rates again. I think it's more likely than not. I would say that, however, please, when I say that, don't overinterpret it. There are, I think, good reasons in our forecasts and our reports suggest that we will see inflation. We will see inflation come off. We will see demand growth start to weaken, and that particularly depending on the prices, on the path of energy prices, that we might see something faster and better than we expect. So there's a lot of uncertainty around, and that's that's for me is the key point in the question. For me, it was a question saying, I think it makes sense to move in a step of 25 basis points. We've then got a period of time to assess that.
The market is pricing in interest rates at 1% by May. Are they right?
Well, my view very much is we've moved by 25. We're going to now take stock. I don't have any number in my head for March or May, so we will take stock. Now, what I would say to the markets is, look, you have to form a view based on what you're observing, what you're observing in terms of the economy, just as we do.
But are they off the mark, or could they be in line with expectations?
Well, we're going to take another view in March.
Of course. Governor, your balance sheet is set to be around 220 billion smaller by the end of 2025, even before thinking, of course, about sales. So do you have an idea of where the terminal size it would be in your mind?
That's a very, very good question. And we don't, actually, in the sense that we don't have a figure. We have no real experience on this front, and we're going to have to find our way. And the reason is that clearly, we're talking about what is the sort of, in a sense, the level of the steady state level of central bank reserves in the system. Now, there are two sort of bookmarks, if you like. There's what it is today, where I would say, it's higher than the steady state. There's what it was before the financial crisis, before we started the quantitative easing path, when it was very low. And of course, it was not just very low from a monetary policy point of view. Critically, it was low from a financial stability point of view. And clearly, the system needs more reserves. We've changed liquidity regulation for banks. Banks have a greater demand for reserves on that basis. So it's clearly higher.
Bank of England Governor there, Andrew Bailey, speaking to us after the central bank lifted borrowing costs yesterday to 0.5%. Well, joining us now is our UK economy reporter, Philip Aldrich, a new Bloomberg hire. So welcome to Bloomberg. It's so nice to have you here, Philip, for many years at the Times. So we have to talk about the Bank of England, the path forward for interest rates. But actually what really everyone's talking about is the fact that Andrew Bailey seemed to suggest that we should not be asking for pay rises because it would make his job much easier in handling inflation. How will that be taken?
Well, I can't imagine workers are very pleased about the fact that 7.25% inflation is something they should just absorb and not ask for pay rises to compensate them for this cost of living crisis. So it's certainly not happening. You're seeing, according to the sort of agents report that the bank puts out and speaks to employers on the ground, they're seeing pay rises of about 5%, which is 20-year highs, basically.
But he must have misspoken, or he must have, or is this really the Bank of England trying to influence, wage increases?
It sounds panicky, right? Because he said it 3 times. So it's not something which he seemed to have made a mistake over and then corrected. And it seems to be part of their communication policy, which is definitely unusual.
Philip, when you look at some of the things that we need to look out for, so now the market is definitely betting on price increases, getting to that 1% in May. Is there a worry? Does the market think that the Bank of England is behind the curve?
Yeah, well, the market certainly believes that, but. And actually, if you look at the Bank of England's report and their forecasts, they think that the markets have kind of they're over-exaggerating the sort of tightening that needs to be done. So we're on course for the fastest tightening in the Bank of England independence era. So there is definitely catch up going on here. But yeah, I think the speed and the sort of terminal point at the moment that markets are estimating is certainly higher than the Bank of England does believe they're going to need to get to.
I know one of the things that you were also asking in the press conference was really wage growth and the fact that, why is that wage pressure has suddenly increased in the last 3 months? Like, how does this develop? And again, is this the hardest messaging for just UK households, that energy prices are increasing and wage growth may not follow?
Yeah, well, I mean, it goes back to the tin-eared comments of the governor. But it's remarkably, there have been signs of wage pressures building in the workforce from July, actually, from before the furlough scheme was shut down. But the Bank of England was not anticipating strong wage growth in November. Now that was their previous set of forecasts. They've increased their estimates, by more than double for what's going to happen. And this is basically because they're hearing on the ground that companies are having to pay up because there's the shortage of labor, there's people are moving jobs much more rapidly, and there's this participation gap. There's something like 1 million people effectively missing from the workforce. So you've got this demand, this huge vacancy, record numbers of vacancies, and this huge demand for work, but there aren't the workers to fill those slots, hence rising wages.
Philip, thank you so much for joining us. Philip Aldrich there, our Bloomberg UK economy editor. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Amazon shares surging this morning following a late trade jump. That's after announcing plans to increase its Prime membership price by $20 a year, the first hike since 2018. Amazon's fourth quarter profit topped estimates, led by its cloud computing division, which saw a 40% jump in sales. The company hired 140,000 workers during the holiday period amid supply chain bottlenecks. Snap and Pinterest shares surged in late trade after upbeat results eased fears that a slowdown at rival Facebook reflected an industry-wide social media slump. Both companies topped Wall Street predictions for sales and earnings, with Snap even posting a surprise profit, its first since it became a listed company. Snapchat soaring more than 50% in pre-market this morning. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, oil at $100 per barrel, well, as global supply tightens, banks forecast prices hitting that key number. We'll have plenty more of that next, and this is Bloomberg. Variant and the latest wave have an impact on not only consumer trends but your business, and do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida, and I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, oil powering towards a 7th straight weekly gain. Investors zeroing in on a fast-tightening global market and geopolitical tensions. Well, joining us now to discuss all of this is Bloomberg's Will Kennedy, our Bloomberg Executive Editor for Energy and Commodities. Well, I have like a million questions on options and actually what we're seeing in the markets, but let's maybe start with Citi now having a pretty bearish position, saying that the market will swing into a surplus. Is there anything that supports this view?
I think there are two things that might lend you to that view. Clearly, people need to see which way the economy goes. Banks are tightening faster than we expected a couple of months ago. If that weighs on economic growth, demand might not be quite as rosy as people suspect. And then on the supply side, we've seen signs that actually the US shale patch, which is a key component in how this market turns out, may actually be stronger than some people expected. We've seen Exxon, Chevron really put forward ambitious numbers for how much they're going to grow shale production this year. So it may be that people want to revise that number. So it is possible to construct a bearish scenario, as Ed Morse and his team at Citi has done, but I think it's a long way from the consensus right now.
Well, if you look at prices, I mean, there's a huge upswing. I mean, it was pretty, crazy what we saw, for example, for Brent yesterday, and even some of the forecasts for WTI. Is this all OPEC missing some of the targets, and will they be able to hit it by May?
I think that OPEC will continue to probably underperform its targets. Every time they say 400,000 barrels, you're going to get a little bit less. The question is how much less. I think the key questions are Russia has fallen a little bit behind. How real is that? Can they catch up? There are arguments about whether they're producing crude or condensates, which is a light form of crude oil. They report in tons how many barrels should you convert that to. So the Russian situation is a little bit opaque. I think how close they get to their targets will matter. Nigeria caught up a little bit. Iraq has fallen behind. So we need to monitor these countries to understand how far short of that 400,000 OPEC is going to come.
Well, I've been dying to show this chart for the whole hour, so let's bring it up. It's basically OTM's open interest in December with a $125 call option, up some 9 times. I mean, it's pretty incredible, actually, how everything's moving.
Yeah, I mean, this is an important part of the market for people to understand. I do think that the options, when you layer the options market on top of the futures market, that does support the bullish scenario. What you've happened as we've had this run-up in prices is that a lot of people, to bet on the upswing, have bought call options which were a long way out of the money, above $100 a barrel. They're getting closer to paying out. And as that happens, the people who sold the options have to cover themselves by buying futures themselves. So you do get this process that the options positioning can help pull the market up. And that's clearly one thing that people think is going on here.
Well, thanks so much, Will Kennedy there, who oversees all of our commodities coverage. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Katie Lyons in New York, Anna Edwards in London. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We've had this narrative of fire and ice, and we think it's going to be icier.
There really is no margin of error for companies that are trading on very, very high price earnings multiples.
We absolutely think that this is the year of the stock picker.
This volatility that we're seeing in the market right now is really cause for opportunity for good stock selection.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, February 4th. Our top stories today. Amazon's wild market swing a day after Meta's stunning $251 billion drop in value. The e-commerce giant is poised to make the biggest one-day gain in U.S. market history. It's a U.S. jobs day unlike most others. Omicron, revisions and seasonal factors have the White House warning that the data could be misleading. And British workers urged to hold off on asking for bigger pay hikes. Bank of England Governor Andrew Bailey warns they could lead to higher inflation. We'll have an exclusive interview with the Bank of England's chief economist, Hugh Pill. That's still to come later on in the programme. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, here in Europe, we focus really on an adjustment, readjusting, bringing forward expectations of rate hikes across the continent. And yet the focus in the US very much on tech.
Yeah, absolutely. And on that payrolls report, Anna, it has been a crazy week yet again, and it still isn't over with that jobs report coming in about 3.5 hours' time. Now, I would note in Asia, it was a pretty positive session overnight. The MSCI Asia Pacific Index up about 0.8% or so. Remember, China and a few other markets are still closed for holidays, but Hong Kong opened back up with the best post-Lunar New Year holiday gain since all the way back in 2009. The Hang Seng Index up about 3.25%, a move that was really led by technology. All 30 members of the Hang Seng Tech Index were higher today, and one of the outperformers was Alibaba, up the better part of 6%. It seemed that Hong Kong was playing catch-up to the gains we saw Monday through Wednesday here in the U.S., not so much to the big losses from yesterday, but of course Amazon setting a more positive tone for Asia overnight as well. I would note, though, while it was a positive day for equities, the global bond sell-off did continue in the region. That was evident in Australia, with the two-year yield there up about 7.5 basis points. We're seeing a lot of movement at the short end of the curve, not just in Australia, not just in Asia, but really globally across the board, Matt.
Kaylee, if it looks like I'm going to cry, it's not because the NASDAQ lost
4% plus yesterday. It's because I got up at 2:30 in the morning. We actually have futures that are moving higher on the NASDAQ, 1.5%, on the S&P, about 0.8%. So it looks like we could bounce back a little bit from yesterday's massive loss. Bitcoin is up 3% from midnight and up about $2,000 from this time yesterday when we saw it at 36. Now it has a 38 handle. NYMEX crude and Brent just absolutely soaring, and I will say that the volume has picked up on these as well. In Brent, like 30 or 40% more volume than we saw yesterday. And gold is also rising at 18.11. So it looks like one of those everything up days, and that's what we need after a day like yesterday. I guess we need that if we're long, right? Anna, not obviously if you're short this market.
Yeah, absolutely. Matt, please don't cry. We're here to help you get through it. Yes, a different picture then coming through on the US futures to what we're seeing here in Europe. Things look much more mixed, much more negative actually here for European equity markets. You can see that very clearly coming through on the map. I pulled out the FTSE 100 because there we are seeing some gains to the upside, up by 0.4% on the FTSE 100. And really it is once again, the story of exposure to various sectors that is pushing the FTSE higher, up by 2.4% year to date for the FTSE, which does stand out compared to other markets. There we go, up by 0.4% on the FTSE. There are a lot of oil plays in there. That is one of the sectors that's really moving higher. This is not a good day for the Xetra DAX. Autos, certainly one of the sectors moving to the downside, and industrials, despite the fact we had some decent numbers coming through from some industrials this week in terms of the number of beats versus misses. We are looking at a higher rates environment, but then again, the euro gains, that could cushion some of the exporters. So it's a complex picture and fast changing over in Germany. Talking of Germany then, I wanted to put this in and show you that this number was positive, but it just slipped down into negative territory. But this is the 5-year German debt yield, of course. And to Kaylee's point about how we're seeing that bond sell-off continue at the short end, well, short end, now the and in the 5-year here we've got, and just 2 weeks ago we were talking about the 10-year going into positive territory. Here, unfortunately, not playing ball. It is still in negative territory, but earlier on it did pop up into positive territory. And the euro hanging on to those gains that it made post the ECB, during the ECB yesterday, up by 0.2%, once again this morning against the US dollar, Kaylee.
All right, Anna, well, let's take a look at what else is ahead today. And the Winter Olympics opening ceremony will take place in Beijing at 7 a.m. New York time. And of course, President Putin will be making an appearance. He is visiting Beijing to attend the Olympics opening ceremony and for a summit with Chinese President Xi Jinping. We were actually just getting some headlines out of IFX that Russia and China have pledged to deepen collaboration in certain areas and also coordinate their global efforts. And then finally, the big event, we will get U.S. jobs report at 8:30 a.m. New York time. We are all waiting and watching for that data, Matt.
All right, we are watching for that data, but what we're really watching for today is Amazon to open up. It is showing Meta how to do it in terms of earnings. The e-commerce giant poised to add nearly $200 billion in market value if its pre-market advance holds. That would be the biggest single-day stock gain in U.S. market history. Let's get more with Bloomberg's Danny Berger. Danny?
Well, Matt, that superlative is just a slap in the face to Meta, who, of course, just saw the biggest loss in history. It really is remarkable to see these huge swings in market value off the basis of just either slight misses or slight beats in earnings forecasts. Now, the bright spots of Amazon really came through in their cloud business, and as well as their advertising business, which, again, perhaps is a slight to Facebook, which saw that big decline. Ad business, I should say, Amazon breaking it out for the first time. We shouldn't, though, forget that Amazon is this retail behemoth, and it did see its online sales drop 1%. But of course, that was more than enough made up for, also because they could raise the cost of Prime membership in the US by $20, and it's clear that their customers want to stick around. So Amazon might be coming to the rescue. We are looking at NASDAQ futures up about 1.5%. Will it be enough to get us away from a bear market in tech? We still do see this ongoing growth, rotation out of growth into value, but at least for now, we seem to at least be picking up steam when it comes to the NASDAQ trade.
Danny, did you get my, there's a tear in my eye reference was to Mark Zuckerberg's video address yesterday. He told Facebook employees, if it looks like I'm crying, it's not because I just lost $31 billion. I scratched my cornea.
Yes. His eyes were pretty red, but I personally, I think my eyes would be a little red if I was looking at $200 billion of losses.
Well, Danny got your reference, Matt, so thank goodness for Danny Berger. Let us ask you, though, about the broader picture around tech then, Danny, because we've been through a wild ride, it feels, this week. Such volatility from Alphabet to Meta to Amazon, and yet, I can't quite believe this, but the NASDAQ really pretty much unchanged, a slight gain on the week.
Yes, a slight gain on the week, but as you were describing, this isn't just trading like a monolith anymore. You see the benefits of a diverse platform like Amazon versus Facebook, or Meta, I should say, that gets all of its value from Facebook, from advertising revenue. But I do want to say that these big gains tend to lead us to something a little more pernicious under the surface. And of course, I'm going to dive into the under the surface moves, because what else would I do? It's not just about tech, these big swings. It is about liquidity that has dried up in this equity market. This is something Goldman Sachs has been ringing the alarm about. This is a measure of liquidity for our radio audience. I'm looking at a chart based on trades in S&P 500 E-mini futures. Liquidity is the worst that it's been since the March 2020 sell-off, based on that lack of liquidity, people playing in the game. So what's happening is we're getting these air pockets. It's something traders are complaining about, and that's part of the reason why we're seeing these gigantic moves in tech based off of slight deviations to earnings expectations.
All right, and pernicious also, a great SAT word, according to Bloomberg, causing great injury, destruction, or ruin. Danny Berger, thanks very much for that. Now, Omicron, revisions, big seasonal factors. Today's U.S. jobs report could be full of surprises, with non-farm payrolls forecasts ranging from a 400,000 monthly decline in January to a 250,000 advance. So big wide bands. Michael McKee, Bloomberg economics and policy correspondent, joins us now for more on what to watch.
Well, Matt, this could be one of the most interesting yet inconsequential reports that we've had in a long time, and I can show you in one chart, sorry for those watching on radio, what the problem is, and that is Omicron, as you mentioned. This is the survey week here, and these are the number of cases, and you can see why there could be a lot of people who were out of work, and if you didn't get paid, and a lot of people in those sectors you were talking about get minimum wage or don't have sick pay, then you're not counted as working, so the numbers could come in very low. The other problems, and I feel a bit like a TV pitchman here, and one more thing, it's not just Omicron, it is also a number of other revisions that are made. 'Tis the seasonals. Ordinarily, companies hire a lot of people going into Christmas, then they fire them in January. This year, because there's so few workers, they might be holding on to them. Annual benchmarks, the Labor Department changes the numbers underlying the numbers because they get more accurate numbers at the end of the year. That goes into the report. And also because we already know what the Fed's going to do. So this number probably going to be forgotten fairly quickly unless there's some sort of huge surprise. We can all watch Amazon instead of the jobs numbers today.
All right, Mike McKee, salesman and economics correspondent extraordinaire. Thank you so much to Bloomberg's Mike McKee. And of course, later today, we will be getting the view on the jobs numbers from the U.S. Labor Secretary himself, Marty Walsh. Plus, President Biden will deliver remarks at 10:45 a.m. Eastern Time. And Bloomberg's Anne-Marie Horton is here with us in New York to join us now with more on the politics of this jobs report. Anne-Marie, the administration already has tried to talk this down to some extent. How does it manage the messaging of a potentially weaker numbers on the employment side, but strong inflationary pressures, especially with oil north of 90?
Yeah, they've already come out on top of this, right, really signaling to the public that January might be a pretty weak jobs report. And they're going to say it's confusing because of COVID. I bring you to the most recent statement of Brian Deese on MSNBC saying, we expect that will have an impact on the numbers. He's referring to COVID-19. We never put too much weight on any individual month. This will be particularly true because they are likely effect of the short-term absences from Omicron, because more people were calling out sick. Domestically, this poses a bit of a pickle for the administration, because when they were getting tons of questions about 7% inflation, they constantly pivoted to the growth they were seeing and the recovery in the employment market, 3.9% on the unemployment rate. We are just a smidge off from where we were pre-pandemic. Well, now they're going to have to answer as well for a weaker jobs report, so it's going to be tough for them.
Am I the only one who's impressed that the administration seems to be really on top of the Russia situation? I mean, now they're one step ahead, it looks like, saying, hey, wait a second, the Russians may release some fake video.
No, you're not the only one. You know what, Matt? Actually, they have been so transparent that there have been top Republicans, like Senator Mitch McConnell, Senator Romney, saying actually what the administration is doing is effective. And yesterday what they said is they came out and they said, we have intelligence that the Russians are planning a false flag operation. They say they've done this in 2014 with the annexation of Crimea. In 2008, they did some of this when they went into Georgia. We should also note in 2008 was the last time President Putin, or last time he was at the Beijing Olympics, summer 2008, and that's when fighting broke out in South Ossetia, and then tanks rolled through Georgia. But we could see potentially a tough legislation package from the Hill next week.
Thanks very much to Anne-Marie Horden on set in New York. Anne-Marie Horden on the US politics beat, of course. Now, the Winter Olympics opening ceremony takes place in Beijing later. President Putin is visiting Beijing to attend the ceremony and for a planned summit with Chinese President Xi Jinping. We've already seen some comments coming through from that summit. Tom McKenzie joins us now with more details. Tom, good morning. So it's going to be busy. We're going to be focusing a lot on China because of the sport and no doubt because of the geopolitics and the people who are and are not in attendance. What do we make of this coming together then of the Russian and the Chinese leadership?
Wouldn't you want to be a fly on the wall for that meeting? So they put out a statement on the back of this meeting between President Xi and, of course, Putin. They're saying that they are now coordinating their efforts, or at least their stance, on the issue of Ukraine. As we know, 130,000 Russian troops on the border there, and deepening their friendship, saying that there is no limits to the Beijing-Moscow, the China-Russia relationship. Look, the IOC says the Beijing Olympics is not politicized. That's clearly not the case. The geopolitics is there, as you say. You've got 21 leaders attending compared to more than 60, close to 70 in 2008, a very different atmosphere. But in terms of what happens with Russia and China, the relationship has been closing up and getting to a point where they are having much closer coordination, a whole range of areas, not just trade and the stance when it comes to the US, but also in terms of military developments as well, military cooperation and technology as well. And a lot of this, of course, is because both countries facing that pressure from the US. The Biden administration clearly would want to singly focus on China, put Russia to one side. That is not happening at this point. So that is the backdrop as these two leaders meet. By the way, for the first time in more than 2 years.
All right, great breakdown. Bloomberg's Tom McKenzie, thank you so much. And now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. We have two massive movers to the upside, Snap and Pinterest. Snap is up nearly 50% in early hours after posting a surprise profit. Both of these companies beating results really across the board, more than offsetting the losses they saw yesterday inspired by Meta. The picture for these two, much better than it was for Meta. Another downside mover on earnings, though, we should note, is Ford. I am sorry, Matt Miller, but big profit miss here. I think it's fair to call it a miss when profits came in at nearly half of what analysts were expecting. They're, of course, dealing with supply shortages, higher commodity costs, all that taking the stock down about 5%. Another company dealing with higher costs is Clorox. They raised their cost outlook, lowered their gross margin outlook as a result. That stock is down 14% before the bell, Anna.
Kaylee, coming up on the program, we'll get back to talking about inflation. Certainly been a big topic of conversation in Europe this week. CPI on the agenda in the US next week. Lots to discuss then with Freya Beamish, TS Lombard, head of macro research. And UK households facing the worst squeeze on incomes in decades. An exclusive interview with the BOE's chief economist, Hugh Pill, coming up in around 15 minutes' time. Plus, Sanofi seeing double-digit profit growth for 2022. We will speak to the CFO of the French drugs company, Jean-Baptiste de Chatillon. That conversation coming up shortly. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kayleigh Lyons, Anna Edwards with us out of London. I've been looking at, for months and months now, wages and inflation to see if it was possible that wages could keep up with a big pop in inflation. I've looked at a bunch of different time windows, so I'm not cherry picking. This chart goes back to 1998, but there's no way wages can keep up with this incredibly strong inflation. And I thought about this when I woke up this morning and realized I'm going to be paying another $20 a year for my Amazon Prime account. And I saw Andy Bailey's comments that workers shouldn't be asking for wage increases right now. Why not? Joining us is Freya Beamish, head of macro research at TS Lombard. Freya, those two things really make me think about this chart. Why shouldn't employees, workers be asking for more money if they gotta pay for more for their stuff?
Well, the idea that Bank of England policy seems to operate through moral suasion now is slightly alarming to me, but it's I think a function of the fact that almost every question in the press conference. You've also had a shift in the level of prices. In the UK, that's been exacerbated because of the loss of European workers. In the US, there's also a migrant element to that. But there's a level shift in both of those things. It doesn't feed through to the wage growth, doesn't keep pace with the CPI because it's a compositional shift towards goods, and it's wage growth that causes services inflation. So CPI is outpacing wage growth for those reasons.
That's interesting analysis, Freya. And so taking that on, I mean, if wages aren't going to give you a step change in your standard of living in the near term, maybe we get better returns from our investments. I was looking at a chart, and just for radio listeners, I'll describe the dwindling pile of negative yielding debt. And this wasn't really much of a phenomenon all the way through, the earlier part of this century. But then in the last 10 years, it became a really big part of our universe, and it caused a hunt for yield. Tina, there is no alternative, drove people into all kinds of assets. But as the pile of negative yielding debt comes down, and we're seeing this today at pace with adjustments at the short end of the German bond curve. What impact is this going to have, Freya, on the ability of people to save and invest for the future?
I think ultimately we do see yields going up, but there are a few kind of hurdles in the path. Funnily enough, there have been many already, and there are going to be more. One is probably going to be a growth scare, as that kind of compositional shift that I was talking about unwinds. And another is going to be a goods price deflation scare, which will happen in developed markets, but will probably be exacerbated by the slowdown in China as well. And so both of those things kind of argue against the more hawkish forecast that we're getting for the Fed, Bank of England, and even the ECB. So yes, there over time, we do see interest rates rising over the course of the next kind of 3 years or so. But in the shorter term, it takes there are those hurdles in the way. And I think it is at this stage a function of the end of QE. If you think of how QE works on the yield curve, really what it's doing is it's increasing the supply of money, but removing the supply of duration. So it flattens the yield curve. When you remove QE, then you remove that kind of directional shift. And when you go to QT, you actually reverse it.
So Freya, is what you see basically a front-loaded hiking cycle?
Yeah, essentially, yeah. Thanks for summing it up for me. Basically, we see them starting in March in the Fed. We've already had liftoff in the Bank of England. We don't see the ECB actually going to hike this year because we think that the kind of the global story on growth and inflation in a cyclical sense will have changed before they actually have to make the decision on hiking, which would come towards the end of the year. But those kind of hurdles will probably come through before they would have to kind of answer the more hawkish side of the market in the second half of the year.
Freya, always great to have you on. Thanks so much for joining us today. Freya Beamish there, head of macro research at TS Lombard, on a day when we're going to get the all-important non-farm payrolls number. Now let's get the first word news. In the UK, the crisis engulfing Prime Minister Boris Johnson's government has gotten worse. 4 top aides have resigned in the wake of the Partygate scandal. Perhaps the most damaging was the departure of a longtime ally, Munira Misra. She quit over what she calls scurrilous remarks that Johnson made about Keir Starmer. A battle has erupted over the pay for Sculptor Capital CEO Jimmy Levin. Director J. Morgan Ruttman quit the hedge fund's board this week after complaining of Levin's pay packages. He said the CEO could get an annual payout of almost $200 million. Levin appears to be slowly turning around Sculptor, though, which suffered outflows for years after a bribery investigation. And the price of oil is set for a 7th weekly gain. Investors concerned over a fast tightening market, geopolitical tensions, and freezing weather in the U.S. West Texas Intermediate set a 7-year high of close to $91 a barrel, up more than 4% this week. As Kaylee told us earlier, shares of Ford are falling. The automaker posted fourth quarter earnings that missed estimates. Plus, it warned of higher commodity costs in the year ahead. Investors have cheered Ford CEO Jim Farley's effort to speed up the switch to electric vehicles. Last year, Ford was top automotive gainer, its stock rising 136%. And I have to say, I have graphed using the comp function on the Bloomberg Ford versus General Motors, Stellantis, Tesla, BMW, Daimler, Volkswagen. They have beaten everybody in terms of their stock gain over the last year. So maybe today's 5% drop is not too difficult for investors to stomach, Anna, because they've done so well in the past 12 months.
Yeah, I thought it was really interesting the way that we're getting more confirmation, though, that the chip shortage is still going to be an issue in 2022. I feel, Kaylee, like we heard lots of executives at the end of last year saying this was something that was going to fade with the turn of the year and things would be better in 22. But once again, another executive pointing to difficulties in this year ahead.
Yeah, I think a lot of people expect it to get better in the second half, but the first half is a very different story, Anna. And Matt, to your point, I think it's all an expectations game, and the bar for Ford maybe was just a lot higher given the run-up the shares had seen, which is why it's getting punished more this morning, whereas a stock like Amazon, for example, was down pretty hard in the run-up to earnings and now is getting rewarded massively for beating. It goes to show you in this earnings season, Anna, beats rewarded, but if you miss, you are punished for it, and punished for it in a big way.
It seems that way. Coming up on the programme, back to macro policy, back to monetary policy, and the economics behind it. An exclusive interview with the Bank of England's chief economist, Hugh Pill. We'll talk about UK wages, UK unemployment, all the factors that go into these Bank of England rate decisions. That conversation coming up next. Francine Lacroix kicking things off with Hugh Pill from the Bank of England. This is Bloomberg.
highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
From New York City.
Here in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
have a great evening.
So recap the headlines.
You do not want to miss this
How are
story.
you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Here is what you need to know. Amazon is giving the market back some of what Meta Platforms took away. The e-commerce giant is poised to add almost $200 billion in market value if the stock's gain in the pre-market holds to Friday's close. That would be the biggest single-day gain in U.S. stock market history. Today's U.S. jobs report could be a tricky one. The median estimate in a Bloomberg survey of economists shows a gain of 125,000 jobs in December, but because of Omicron, revisions and seasonal factors, White House officials warn the report could be confusing or misleading. The range of estimates is very wide. Bank of England Governor Andrew Bailey warns that workers should hold off on asking for bigger pay hikes. He says it could lead to higher inflation. That led many on social media to accuse Bailey of being out of touch. They noted he makes more than $780,000. Coming up, we will speak to the Bank of England's chief economist. Hugh Pill joins us. That is a look at what you need to know this morning. Matt, a range of topics to cover then. And as we head towards the start of U.S. trading, of course, the jobs number and technology once again in focus.
Yeah, the all-important jobs number, maybe not as important today because we had this incredible tech swing, right? Yesterday, Facebook lost $250 billion in one day, the most any company in the world has ever lost in one day on the stock market. And then today, it looks like we could see Amazon gain more than any company in the world has ever gained. The Amazon gains pushing up NASDAQ futures, not as strong as they were a half hour ago. We were gaining 1.5%. Now NASDAQ futures are up 0.8%, but that's still good to boost the S&P, as well as the Dow futures also rising. Bitcoin is up right now 2.5%. It's a 37, almost a 38 handle. That's where that's $2,000 more than where it was yesterday at this time. So some decent gains for Bitcoin, some serious gains for crude. This is NYMEX 91.58. That looks like a Brent quote, and Brent is obviously higher than this, so some real gains again. 7th week in a row for oil, and gold is up 0.5% right now, 18.14. It's kind of an everything rally. Kaylee, what do you see in terms of the pre-market movers?
Well, of course, you know I have to start it off with Amazon. Big move to the upside on a big beat on profits. $27.75 a share. The average analyst estimate was for $3.77. I mean, they just blew it out of the water, thanks in part to their stake in Rivian, but thanks also to strength in in the cloud and the advertising business, plus that $20 price hike for Amazon Prime. $139 is what you will now have to pay. Personally, that's worth it because I really rely on Amazon for pretty much everything. That stock is up 12% in early hours. As we've been saying, could be the biggest market cap gain for any company ever in U.S. market history. And of course, that follows the biggest loss ever for Meta yesterday. And of course, Meta yesterday also dragged down Snap and Pinterest because it seemed that they could face some of those same headwinds. And instead, they really surprised in a positive way after the bell, beating estimates across the board, even for Snap posting their first profit ever as a public company. Snap shares up 49.3% in early hours, just a massive move, more than making up for the decline it saw yesterday. For Pinterest, it's up about 15.5%. But as we've been talking about, not so positive story for Ford. They missed on earnings and profit in a big way thanks to supply shortages that they are still grappling with, higher commodity costs as well. And as a result, that stock is down more than 5% before the bell, Anna.
Yeah, contrast there between Ford and the tech names. Really fascinating, the Amazon story. They don't always make money out of the things that you think they do, the things they're better known for. Let's have a look at where we are on the European markets then. And we're pretty divided. Many of these markets trading to the downside. Concern around higher rates, perhaps part of the mix. Some of the industrials, some of the auto names, that's certainly weighing on the German market. We're down 1.1% on the Xetra DAX. To the upside, though, the FTSE 100 clinging on to positive territory, up by 0.25%. Exposure to oil stocks, of course, is a big positive on a day like today, where we see further gains coming through in oil. Interesting to watch what's happening in the German yield curve. We're seeing, well, 2 weeks ago, we were talking about the 10-year yield going positive. Just today, talking about the 5-year yield going positive. Nearly made it yesterday. It made it in the early hours of this morning here in Europe. It's just back down. Oh, no, it's now in positive territory. There we go. 0.007 is the yield on the German 5-year. And I put in here the euro pound. We've seen some movement to the upside here, up by 0.6%, a 6-week high on this one. Our colleagues on the Markets Live blog saying it was hard to find euro bulls before yesterday. And of course, a lot of that has changed. Let us take the other side of that pair, though, talk not about the euro, but about the pound. The Bank of England is on the cusp of the fastest tightening monetary policy since it gained independence in 1997. In an interview with Bloomberg's Francine Lacqua, Governor Andrew Bailey said he favoured moving interest rates gradually instead of delivering an unexpected shock.
I think it is likely that, we will raise rates again. I think it's more likely than not. I would say, though, however, please, when I say that, don't overinterpret it. There are, I think, good reasons in our forecasts and our reports suggest that we will see inflation. We will see inflation come off. We will see demand growth start to weaken.
And in further interviews this morning, Andrew Bailey urged British workers to hold off on demands for higher pay, saying the nation needs to focus on keeping inflation in check despite the mounting cost of living, the cost of living squeeze. Francine Lacqua joins us on set here in London to take us into our next conversation with the Bank of England's Hugh Pill. Francine, good morning.
Yeah, thank you so much. I'm delighted to be here, really to talk about some of the things that we heard from the Bank of England, Anna. And yesterday it was very clear that there's uproar on social media about the fact that Andrew Bailey says, look, we need to keep a check on inflation, maybe by not asking for wage increases. I'm delighted to be joined by, of course, Anna and Hugh Pill. Hugh, what a day. I mean, was it miscommunication or mismessaging from the Bank of England yesterday? I mean, it's a very tough pill to swallow in saying, guys, please don't ask for a pay rise because it makes my life more difficult as the Bank of England.
Well, I think what we saw yesterday was a bank response, a continuation of the bank's response to a shock to the economy, which is posing us with difficult challenges and posing the UK economy with difficult challenges. I mean, I think there are sort of three big features of where we stand around that. I mean, the first is this is a shock to energy prices and to international goods prices, which have risen much more than expected over the last 6 months, year or so. And those are things the UK imports. So from an economist's point of view, we might call that a terms of trade shock. If things we're buying are costing more than the things we're selling, that is going to weigh on real incomes in the UK. And that is an unavoidable thing. The second thing is that's a big shock. Energy prices have risen very rapidly. Right. Wholesale gas prices rose 400% over the last year.
But Hugh, if we focus just on wage growth a little bit, is there a level of pay increase that the Bank of England would be comfortable with that wouldn't filter through inflation too much so that you have to be much more hawkish?
Well, I mean, I think the key thing is, given the nature of the shock we're facing, real incomes in the UK will suffer to some extent. That is unavoidable. There's nothing that policy in general, or monetary policy in particular, can do about that. Who suffers that cost is something that monetary policy can't really have much say about the distributional effects of that. What I think monetary policy can and should focus on is ensuring that we don't see a repeated attempt, which is inflation generating by different groups, different workers, firms, etc., to try and shift the burden of that shock onto others by pushing up their wages, pushing up their margins, whatever. So we are trying to avoid the emergence of these famous second-round effects from the energy shocks in order to keep inflation falling towards target as the direct impact of the energy price rises drops out of the calculation of inflation. And that helps us create the sort of more stable macroeconomic environment, which I think is to everyone's benefit over the medium term.
Hugh, a lot of traders are trying to figure out, first of all, the sequencing, some of the corporate bond selling, what that exactly means. But where do you see the neutron terminal rates?
So I think, my own view on that is that we have to be cautious in communicating where R star or the neutral rate is. The forecast we put out yesterday, had three big moving parts. It had this energy price shock we've already discussed. There's a lot of uncertainty about that, and we showed these two different scenarios, which I think showed the sensitivity of the inflation outlook to different paths of future energy prices. We also, as we've just discussed, had some assumptions around the outlook for wages. Our forecasts embraced the fact that the labour market today is tight. It's tighter than we expected back in November in the course of our forecast last year. And I think it's expected to tighten further over the next few months. And that's led the information we get in our surveys of firms and so forth to see that expected wage increases over the coming months are going to be elevated.
And that's clearly what you're concerned about. But there's a difference between saying, and good morning to you, Hugh, there's a difference between saying that you're concerned about inflation and second-round inflation effects and higher wages, and telling people not to ask for pay rises when they feel the pressure and they feel the cost of living going higher. Do you think maybe that message should or could have been worded a little differently?
Well, it's not for me to criticise my boss, so you're not going to get me to do that. What I do think is that, a key assumption in our forecast and a key element of why, admittedly, on a path of interest rates that is derived on market expectations, which involves further increases in rates, which our communication yesterday also acknowledged and to some extent embraced. I think it is key to see that the assumption we have is that we don't see, from the middle of next year, persistence emerging in wage and domestic cost developments stemming from these second-round effects. And it's that lack of that, the fact that policies, including monetary policy, do enough to avoid that, that is central to bringing our inflation back towards target.
Okay.
If we were to see developments that were not consistent with that assumption, then of course we would have to think about further action.
So that's why you're so focused on the pay restraint point. You mentioned the expectations in the market about hikes. Are you happy with where the market is positioned post the meeting? Because in the 2021-22 cycle, we're now looking at 6 hikes in 7 meetings. That's more than in any hiking cycle since independence for the Bank of England in 1997. Maybe that's right. These are pretty unprecedented times. Does that sit well with you?
Look, I'm not going to comment at length on the outlook for interest rates as priced. I think our communication yesterday had 2 elements, and I think probably both elements need to be taken into account in coming to some sort of assessment from the market point of view. As I've already said, we are not running away from the fact, and indeed we state that in the coming months, and as long as things play out broadly as we expect, we would expect to see a further modest tightening of monetary policy, which would embrace a rise in the bank rate. But I think it's also important to see, in parallel with that message, we published a forecast. That forecast, of course, is based on assumptions about interest rates, it's based on assumptions about wages, it's based on assumptions about energy prices. Those are the 3 big moving parts and interrelated parts in our forecast. But that forecast led to an outlook for inflation in 2 to 3 years' time that is below target. So when the governor says market should not get carried away, I think they need to take into account that our view of the world, conditioned on the fact that energy prices stabilize or perhaps fall from here, and conditioned on the fact that whether taking his advice or not, we do not see the emergence of second-round effects in wage and domestic cost dynamics, inflation will fall back towards target and potentially below it on how markets were pricing when we were making that forecast back at the
end. Hugh, on the back of that, is the Bank of England actually happy to have the most negative real yields in the developed world?
Well, I think we are going to set policy, both with short-term rates, bank rate, and with other dimensions of policy to achieve our target. If at the moment that requires us to have real yields to sustain recovery, then I think we're comfortable with that. I think, we are looking through time for, as that recovery progresses, to see a normalization of the economy, inflation return back to target, and hopefully, as the very long legacy of the financial crisis, Brexit, and COVID recede, back to a more normal level of real interest rates, which hopefully would be positive, reflecting positive returns in the British economy.
Okay, let's all hope for normal. Hugh, thank you very much. Thanks very much for joining us. So the Bank of England Chief Economist, Hugh Pill. And of course, thank you to Bloomberg's Francine Lacroix for bringing us that interview. Kayleigh.
Well, Anna, I do want to bring some breaking news out of another central bank, the Norges Bank. Jens Stoltenberg has been named governor of Norway's central bank. Stoltenberg, of course, is the current Secretary General of NATO, the former Norway Prime Minister, and he'll be replacing Øystein Olsen, who has been at the helm of the Norges Bank since 2011. Stoltenberg will be appointed governor for a period of 6 years from a date that is yet to be decided by the Finance Ministry. But again, Matt, Stoltenberg, the next head of Norway's central bank.
All right, very interesting move there. A little career change for Jens Stoltenberg. Coming up, Sanofi forecasts double-digit profit growth for 2022. We'll speak with the CFO of the drug maker, Jean-Baptiste Deschatillon. Next, this is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kayleigh Lines in New York and Anna Edwards in London. French drug maker Sanofi expects double-digit profit growth in 2022. That's as its blockbuster asthma and eczema drug Dupixent extends its reach in the U.S. and Europe. Joining us now to talk more about what's to come is the CFO, Jean-Baptiste Deschatillon. Jean-Baptiste, thanks so much for joining us. Talk to us about the growth that you see first in 2022 and what headwinds you might be facing.
Yes, thank you very much, Matt. We are really happy to see the trend the company now is creating with great results in 21 and great expectations for 22. We are effectively guiding for low double-digit EPS growth in 22. And this is supported by the dynamic of our specialty care business, but also our vaccine business. We have enjoyed more than 7% at constant exchange rate growth in 21 of our top line. And this is showing the dynamic we have within our priority growth drivers.
Good morning to you, Jean-Baptiste. On the subject of COVID-19 and vaccines, I know that you've been working on yours. It's in late-stage trials. It's been there for a few months. Can you tell us about the time horizon? When should we hear more? And how does Omicron play in here? Does it make things easier because there's more of the virus around to test your vaccine against, or does it make it more difficult because, of course, it's a new variant and that can behave differently?
Yeah, we are just expecting our phase 3 results in Q3 as expected, so more to come on that topic. What is quite interesting is to see that we are now deeply investing in our mRNA platform with modified mRNA, with a second generation of mRNA that we want to develop, for instance, in flu, but also in many other targets. We have, for instance, made an acquisition recently of Origin to really hit new areas like acne with our mRNA platform, and that's quite exciting. So yeah, we are all in developing our new generations vaccines. But as I said, for COVID-19, we're just waiting for phase 3 results in Q1 of this year.
Talking about new areas, not just for mRNA, but new areas for Sanofi to expand, are you currently looking at any other acquisitions? What's your appetite for that?
Yeah, it's been in 21 on 2020 an incredible years. We've done some 9 acquisitions, one of the most active company in the M&A landscape. But we have laser focus. We are really concentrated on immunology, oncology, some of the vaccine areas, especially around our mRNA investment. So yes, we want to go on within our capital allocation. We have high interest in adding to our early science with bolt-ons.
I want to get back to Dupixent and ask when you're going to hit $10 billion or euros in annual revenue. I know that's part of the plan. How soon can you get there?
Yes, thank you, Matt. It's effectively a drug which is bringing to patients an incredible relief, and it's developing worldwide at a high speed. When we first mentioned in December 19 that the target could be 10 billion plus, there was some skepticism. But now that we are analyzing above 6 billion euros per year, effectively, we will have to review this target up because we are adding new indications, we are adding new geographies, great start in China, for instance. Yeah, sooner than later, we'll have to revisit this target of 10 billion plus.
Okay. Jean-Baptiste, we're heading quite rapidly towards the French election, the French presidential election, and as working at the top of a French business, I'm interested in what reforms you think are most important. The French economy enjoying quite a strong rebound compared to other European countries at the moment. What is the biggest reform you want to see, though, take place?
Well, I won't step into much politics, but what we know is that effectively the setup in France in terms of investment, in terms of biotechnology, the environment for research is improving in France, and we are benefiting from it. We are part of it, and there will be some other announcements of our investments in science in France, because we think that we can really develop and have great successes. For instance, our mRNA center is split between Lyon, a town in France, and Boston in the US.
Okay, so a focus on French science. Thank you very much, Jean-Baptiste. Really good to have you with us today. Jean-Baptiste de Chatillon, the Sanofi CFO. Don't miss Bloomberg's monthly series, Chief Future Officer. The latest episode features Mondelez CFO, Luca Zaramella. You can also check out our interview with the Macy's CFO, Adrian Mitchell, both available on Bloomberg.com and on YouTube. This is Bloomberg.
soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. And now a look at what we're watching to end the week. I, of course, am watching the U.S. jobs report. 8:30 a.m. Eastern time is when that will drop. Economists expecting an addition of about 125,000, but we could see a negative number. It is potentially a thing that could happen. Of course, we'll also pay attention to wage growth, those inflationary pressures, and does the labor force participation rate go anywhere? Economists don't think it will. Still firmly at 61.9%, so we'll watch for that data, Matt.
Yeah, well, I'm going to watch the jobs number, of course. It's always fun. And I highly recommend Bloomberg Terminal users check out WHIS Go to try and beat your colleagues in a contest of forecasts. I'm watching Amazon, though, to see if they can make another world record today, adding the most any company ever has in a session. Yesterday, we saw Facebook lose the most any company ever has in a session. I will point out futures are weaker than they were when we kicked off the show. And even though Faro doesn't care, Dow futures are actually down right now. But we still have gains on S&P futures and NASDAQ futures, Anna, so it could be an up day to end the week.
Yeah, could be a little divided now, a little more divided than they were earlier. I'm watching UK politics, the Prime Minister losing at least 4 advisors in the last 24 hours. How long can he hang on? How long do we keep asking that same question? We've certainly been asking it for weeks now. More Bloomberg surveillance is ahead. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project. Initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
I think the frothier areas of the market will continue to have headwinds.
Inflation in the wage costs. We're talking about inflation in materials, inflation in logistics.
The reality is inflation hurts, unemployment hurts.
Where did all the workers go? And are they ever coming back?
We've had this narrative of fire and ice, and we think it's going to be icier.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity pop fades on the S&P. It's positive about 1/3%. The number TK, the estimate, down to 125K.
Yeah, it's a jobs day, and it's a moving jobs day. At least what I think is important here is Farrow saved the great bar chart for his other property at 9 a.m. yesterday. The Morgan Stanley shift, John, that you showed beautifully in the 9 o'clock hour and not on surveillance on radio and television was really
You're not complaining at all, are you?
Of where we are saving our graphics for 9 a.m., which is a huge, John, let's say 400,000 body shift for Ellen Zentner.
These are things we can settle before the show starts, Tom.
Can we?
Not when it commences. The estimate from Morgan Stanley, -215. Lisa Goldman at -250K a little bit later this morning.
Honestly, that's not even the number that I'm watching, though. It really is the wage number and the participation rate, considering the fact that even though this does seem like a negative print, it's because the workers are not there. It is not because of a lack of opportunity. And as a result, you can expect those wages increase potentially more than people previously expected.
I'm already looking at CPI next week, Tom. The estimate now, the median 7.3, the high 7.6, the low is 7.
For our American audience on radio and television, with all the distractions, the tech derby, Meta, Facebook, all this other baloney, John, we need to underscore that inflation report next week has changed because of the historic day we saw yesterday from the Bank of England, and then even more stunning, the shift from ECB and Lagarde.
Would you like to discuss the $200 billion worth of baloney, Tom, in the free market?
I was just going to say.
I mean, just off that now, Amazon's only up 12% in early trading, Tom.
Look, what this comes down to is execution of business plans, which is Graham Dodd 101. And I would point out that the revenue take of the successful 4, Apple, Amazon, Microsoft, and Google, was over 20% per year last year.
I've got the Bramo cam, Tom. As you're speaking, she's shaking her head. She thinks it's something else.
Well, honestly, we're talking about massive $1.9 trillion companies swinging in value by 12, 15%, 25% yesterday if you look at Meta or Facebook. Honestly, we're looking at $200 billion swings one way or another each day. How does this get baked in for a volatility premium after years of not seeing moves of more than a couple percentage points a day? To me, this is a game changer at a time when we don't have a backdrop of certainty.
TK, final word on this one.
I would look at business execution. I'm going to say this again, John. I said it yesterday. The most important earnings announcement of the week was UPS. Imagine the challenges Big Brown goes through. They hit the ball out of the park because they executed Others didn't. Look at McCormick Spices. They go up to a record high yesterday. They're doing 3, 4, 5% revenue growth off of, Italian seasonings, Johns, that you put in your Apulian artichokes. And the fact is McCormick's killing it on execution.
I think you and Bramo are on two very different pages this morning, and we can discuss that a whole lot more. Futures this morning at 125. We'll try. On the NASDAQ, up 120, up 0.8%. On the S&P, we had a bounce, and now it fades. Up a little more than 0.1% on the S&P. On the week, if you've lost track, we're still positive coming into Friday by about 1% on the S&P 500. In the bond market, 181.31 on 10s. The euro positive. Euro dollar 114.62. Tom, we've got a lot to talk about on the ECB front. We'll do that later.
Yes.
That currency pair, Lisa, up 0.2%.
Yeah, a game changer. And I do have to say, I'm talking about $200 billion swings. Tom's talking about McCormick Spices and Italian spicing for artichokes. It all comes together and actually does tell a cohesive story, I promise. Today, 8:30 a.m. is the big event, January payrolls report. It is expected to be a softer print, possibly the first negative reading that we've seen during President Biden's tenure. However, as I said before, I really am not that interested in that. What I'm looking at is the labor force participation rate. Does it stay so far below where it was pre-pandemic? Are we seeing people remain out of the workforce and even possibly leaving after coming in because of the Omicron variant? And then how does this factor into earnings? The expectation is it could potentially push them even higher than many people expected, an annualized level north of 5%, as there are fewer applicants for a lot of these positions, and also as some of the lower tier individuals, the lower paid individuals are the ones that remain out of the workforce, given the Omicron and the service-facing nature of a lot of those jobs. 10:45 a.m., we'll hear from President Biden. How does he dovetail the need for more financial spending at a time when you've got an unemployment rate of 3.9%, possibly even lower? How does he talk about the idea of filling roles and an infrastructure plan? We don't have enough workers. Does he talk about immigration? Does he talk about workforce programs? How does he dovetail the reality versus the goals? And today, Vladimir Putin of Russia and Xi Jinping of China are holding their first in-person meeting in more than 2 years on the sidelines of the Winter Olympics. I find this actually fascinating as the Winter Olympics kick off. The relationship between Russia and China, at the increasing tensions of Ukraine and Russia, at some of the issues with Kazakhstan, given the fact that they supply so much of the world's uranium. How do we look at this new force, this new alliance between China and Russia, and how that might be the biggest message coming out of these Olympics?
Lisa, thank you. Are we catching up with AMH this morning?
Yes.
Is Anne-Marie on? Looking forward to that a little bit later. I hear, Tom, she's in New York.
I think there was a sighting. I think there was a sighting. Well, I didn't see her, but I saw her entourage. I saw the back end of it.
Looking forward to that. And all the Gucci, just the bag's full of it.
So
Steve
she
Whiting
has separate people to carry that stuff for.
Joins us now. Steve Whiting, the Chief Investment Strategist, the Chief Economist at Citi Global Wealth Management. Steve, we get a lot of notes from guests, and typically your notes aren't full of hyperbolic language. They're pretty constructive often. And this line just jumped out to me. Powell's current inflation-fighting mode makes it more likely that a new policy error will occur. That's unlike you, Steve. Why do you think that's the case?
Well, we just want to make sure that investors understand that policy risks have gone up. The facts on the ground in the economy really haven't changed. The Federal Reserve's approach is in question. When we've seen very large turns in open-ended monetary policy tightening after all of that guidance to suggest we needed patience, we have to be concerned about that. How the Fed will react, what it intends, how it sees its policy impact. We see a pretty significant policy impact if the Federal Reserve tightens with two tools at once. So, look, I think the really important thing is we've been through a shock to the world economy that's really been tremendous turmoil. The closest thing we can really compare this to, even though the drivers are very different and the areas of strength are very different, but a wartime economy. That's the kind of underlying impairment of the supply side that we've had, the turmoil in the economy. We think that repair is coming. Imports surged 20% in the U.S. economy in the fourth quarter. Inventories went from decline to one of the largest gains in history. We need a lot more of that, right, to rebalance supply and demand. But progress is there. Again, we have enough patience to wait this out, or do we just try to crush demand?
Steve, okay, I'm going to go with you on that because I think it's been a huge topic, this restudy of 47, 48 and quote-unquote a wartime economy. You can take it over to Vietnam as well. You come out of a war for whatever reasons, you have a shock, you have the inflation like we saw in 47, 48, and then after that, what's not talked about is a great Eisenhower disinflation. Does Citigroup and your linkage of the equity market into economics, are you modeling a disinflation vector off of the inflation we see right now?
Well, one thing we have to clearly agree with Chairman Powell is supply and demand have to grow at more similar rates for the expansion to continue. Inflation is a threat to expansion. If for some reason we can't have more stable prices while we're not conducting more stimulus, it'll harm consumers. We already see a slowdown in the demand side of the economy, the absence of stimulus since 1Q 2021. Now, again, there's still a good tailwind of strength. It seems to be coming down. But really, are we talking about a supply side that we can't have patience with? What if COVID, for example, spreads to China in a way that will, again, give us a relapse? What can we accomplish with knocking down demand hard? Now, again, not saying the bond market is not saying that the Federal Reserve is heading there, but after wartime, after these times when you just can't stabilize prices, you really don't knock inflation down so purposely. You're not going to get that purchasing power back.
Steve, just real quick here, because unfortunately we're running out of time, but did yesterday's ECB meeting shift any of your conviction, given the fact that suddenly we are reframing an ECB move through the end of this year?
Well, it's certainly, again, the same sort of picture that central banks are running out of patience elsewhere. And again, the BOE, again, has already taken some action. We think in all likelihood they will be more patient, but just simply not repeating the mantra of, avoiding all rate hikes in 2022 is the news.
Steve, wonderful to catch up, buddy. As always, Steve Wining of Citi Global Wealth Management on this Payrolls Friday, following a big move from the ECB. Let's be clear, they did not hike interest rates, but that's the closest, Tom, they have come to even thinking about interest rates and hiking them in more than 10 years. You've got to go back to July 2011 for the last time an ECB president made a move to hike rates, and that was Trichet.
Yeah, John, I think you and I saw it in real time in the 9 o'clock hour in our different properties yesterday, and I'm sorry, the markets reacted with a consistent force as Lagarde basically spoke a Germanic angle. I mean, it was hugely towards, I'm sure, what the Germans are thinking about.
You mentioned the line from Deutsche Bank, Tom. Lisa, this is what Deutsche Bank's got to say about it. The two largest moves in FX markets over the last 12 months have been driven by hawkish FOMC pivots in both June and January. We would see this as an equivalent pivot for Europe. They close out their euro-dollar short. They go long. So now we look at a big adjustment in the rates market and in foreign exchange too, potentially, through the next 6 months.
And how much does this affect some of the bets where people were going overweight Europe because they thought they would remain on hold for longer and it would allow the economy to accelerate? I mean, I just wonder how many massive shifts in strategy and conviction happen in the next couple of trading sessions.
There's so much going on at the moment, Tom, that we haven't even mentioned crude.
Yeah.
TKWTI with a 91 handle.
On a dash to 93 on Brent crude. 93 is not 90. Crude this is an unspoken story. It's really on the move, John.
A persistent grind higher through the year so far. Tom Keene, Lisa Bramis and Jonathan Ferro on this Payrolls Friday. The median estimate, what is it, 125K? That really does not tell you the story. We'll talk about a story through this morning. Futures dipping into negative territory, down 0.1%. This is Bloomberg.
With the first news, I'm Ritika Gupta. Amazon is giving the market back some of what Meta platforms took away. The e-commerce giant is poised to add almost $200 billion in the market value if the stock's gain in the pre-market holds to Friday's close. That would be the biggest single-day gain in the U.S. stock market history. Amazon reported cloud sales that beat estimates, plus it raised the price of Amazon Prime subscriptions. In the UK, the crisis engulfing Prime Minister Boris Johnson's government has gotten worse. 4 top aides have resigned in the wake of the Partygate scandal. Perhaps the most damaging was the departure of longtime ally Munira Mirza. She quit over what she called a scurrilous remark Johnson made about opposition leader Keir Starmer. In Beijing today, China's President Xi Jinping met with Russia's Vladimir Putin. Putin is attending the opening ceremonies of the Winter Olympics. He and Xi are said to have discussed relations between the two countries and exchanged views on strategic security. Moscow has been courting China at a time when the US and Europe warn of imposing sanctions over the Ukraine crisis. And the price of oil is set for a 7th weekly gain. Investors are concerned over a fast-tightening market, geopolitical tensions, and freezing weather in the U.S. West Texas Intermediate set a 7-year high of close to $91 a barrel. That's up more than 4% this week alone. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
Earning inflation season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Payrolls 2 hours away from New York City. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Let's get straight into it. The pop on Amazon sticks just a little bit, then fades. And we fade on the S&P too into negative territory. On Amazon, we are still positive by 11.6%, but it will not keep this market up on the S&P. On the NASDAQ 100, up 0.6%. For crude, you heard the story, 7 weeks of gains on WTI. We have a 91 handle. Year to date, up more than 21%. And there's the headline, Tom. The headline that this administration probably doesn't want to see ahead of CPI next week. U.S. average retail gasoline price surging to the highest since 2014.
John, I think we got to rip up the script here as we did yesterday with the stunning bank meetings that we saw. Bank of England, I think, really out front in terms of inflation worry. That number next week, John, is 7.3%, up from, I believe, 7.0, 7.1%. Unleaded gas on the Bloomberg. This is a standard that everybody uses. It's not your gallon of gas. It is within half a penny of getting back to those record highs. And the word I'd use, John, is suddenly this cost of living story is back front and center.
In a massive way, Tom. Credit Suisse is 7.4% for next week, by the way, on inflation. Lloyd's at 7.6. 7.6 is the high. Now, you can explain away a disappointment on payrolls a little bit later. You can do that by talking about Omicron. As we go into next week, Tom, the cost of living, real wages, the wage adjustment relative to where inflation is right now, it's tough for this White House, and you see it captured in the sentiment numbers week on week in America.
Political football 1 week out from the Super Bowl. Anne-Marie Horton joins us here. She has seasons to the Washington Commanders and joins us in our New York studios.
I do not.
Today. Anne-Marie, she said, I love the New York Giants tweet that Tom Brady retired with all this distinction after losing 2 Super Bowls to the New York Giants. I thought that was great.
So did my dad.
We got to talk about Ukraine? No. We got to talk about the death of Islamic State? No. We have to talk about cost of living. What is a to-do list for the Biden administration of what everybody, rich, poor, what everyone feels with this inflation?
Well, exactly, especially this headline right now. This is the AAA. These are pump prices.
Yeah.
This is potentially how you will not get reelected if you have gasoline prices higher. And I think the entire inflation story is just going to be pinned on them, especially today. Because usually when they have a good jobs number and people ask questions about inflation higher, though, and this is the cost of living, everyone feels it, as you say, rich or poor, they pivot to, well, there's been a recovery in the jobs market. They're not going to be able to do that today. They say the jobs today is going to be confusing because of COVID, and inflation is going to be the key hurdle. This kind of headline is going to get the backs up of people at the White House.
I believe Mr. Farrow, with his other property, will speak to the Secretary of Labor today. Marty Walsh is a feet-on-the-ground guy from Dorchester, Mass., former mayor of Boston. He's a scrappy guy. What does he think of the Biden tone here? Are they finessing this, or is there a sense of sweat at the White House that 7% is not acceptable?
Well, for the jobs number, they've come out and flagged it. This is not going to be a good month. Inflation is tricky. They will say that the Fed is independent. It's on the Fed to deal with this, and they will pivot to things like Build Back Better. How do we get prescription drug costs down?
Marty Walsh is going to talk to John Farrow about Build Back Better today.
I imagine he might mention it, yes. He's part of the administration. He's a cabinet member. Why wouldn't he?
But Anne-Marie, how much are they going to dovetail into the greenification and the speed of that while also supporting the fossil fuel industry? This is such a fine needle to thread for them.
It's a huge debate within the energy industry and within the administration. Is the energy transition far enough along where they should not be focusing a little bit more, whether the government, also the private investment community, in the fossil fuel world? You're seeing higher oil prices. This is going to affect consumers. Look at the Michigan consumer sentiment. Jonathan and I have spoken about this. Regardless of whether or not you are a Republican or a Democrat, your key concern, 75% are saying inflation. All of the polls, even though there's a number of issues facing this administration, especially on the foreign policy front, which has really gotten the entire attention of Washington, D.C., what matters when they go into those midterm elections is going to be where inflation is and where individuals are when they're paying their grocery bills and they're filling up their gas tank.
So let's do this. Let's fold in the foreign policy story. Is there a number they can dial? A phone call they can make? that they're unwilling to make right now?
1-800-RIAD, maybe. I think if they called the kingdom and put a little bit more, as Tom would maybe say, finesse in that relationship. But this was always going to be a tough relationship, Washington and Riyadh. The Trump administration really welcomed Mohammed bin Salman, who is the crown prince. He is not the king, which this administration says we are going to deal with the Saudi Arabia relationship from one counterpart to the other counterpart, which means the president of the United States with King Salman. And there's been a number of people who said to me, if they really do want to get Saudi Arabia, which is the one that has the spare capacity, could be the ones that could move the oil market, the president needs to pick up the phone to Mohammed bin Salman. That is something this administration at the moment has not been willing to do.
What about 1-800-HOUSTON?
That's a great question, Lisa. You know, I think there's been talks that, especially when it comes to the natural gas market and potentially LNG going to Europe, there has been talks with the fossil fuel industry, and at the moment those talks seem to be on board. But the tone from this administration, as opposed to the prior administration with the fossil fuel industry, is that they felt like they've been treated a little bit more with hostility. And there's a number of experts in this administration who are fantastic on climate, but do they really have a number of individuals who are focused on the fossil fuel industry? And right now, that is where the domestic pressure is.
AMH, thank you. From D.C. to New York. Welcome to New York City. Back home for a little bit anyway. Lisa, did you see the headline from the governor of the Bank of England? Can you imagine if the chairman of the Federal Reserve said what Governor Bailey said yesterday? Don't ask for a big pay rise. Don't ask for a big pay rise. And then when he was asked to clarify, this was the quote. When the BBC leads with that headline in the UK, that is not good news for the conversation
you're in
at
trouble.
all. In the sense of saying we do need to see a moderation of wage rises now. That's painful. I don't want to in any sense sugarcoat that. It's painful. But we need to see that in order to get through this problem more quickly. I mean, that's the situation we're in. Energy bills just shot up yesterday for a lot of people in the UK. Their mortgage costs might have as well. And the Bank of England governor's following it up by saying, don't ask for a big pay rise this year.
In the United States, they would be eviscerated. They would be basically raked under the coals by not being aware of what's going on the ground. There's a nuanced argument about who is seeing the pay raises, whether it's at the top and whether that's going to get passed along to the prices that are experienced by the bottom in terms of earning power. However, in terms of earnings, higher wages at this point are viewed as a good thing so that people can get ahead of the wages of the price increases that we're seeing globally.
They must be pretty worried about things, Tom, if they're worried about people asking for a too big a pay rise this year.
You mean in the United Kingdom?
Sure.
Yeah, I think so. And I think each of these stories is different, John. And it has to do with the giant mass, the weight of the U.S. economy versus a much more service sector, smaller economy of the United Kingdom. Yesterday was stunning.
I agree with you. It was fascinating. And the ECB followed up in a way that I don't think many people anticipated. The amount of calls for ECB rate hikes that are pouring in at the moment from SocGen, Capital Economics, I think Goldman in the mix now.
Yep, Deutsche Bank.
Deutsche Bank, I'm losing count, Lisa.
Yep.
Futures down a tenth on the S&P, euro dollar positive, 114.64. More on that in just a moment. From New York, this is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I've lost track of this week. On the week, we are up 1% still. I've lost track because I think Alphabet shot higher and took the market with it, and then Facebook shot lower and took the market with it, and now it's Amazon, and Lisa's got things to say. We'll get to those things in a moment. Futures are negative on the S&P. We come back in 3 points, down about 0.1%. The Nasdaq 100 holding on to gains, up 0.6% on a session so far. Those two names we've been discussing, let's talk about them now. Switch up the board and get to Facebook. With the biggest market cap drop ever in the history of the US market yesterday, today up 0.8%. And Lisa, potentially today, not at these levels, maybe a little bit higher, we could have the biggest market cap pop on a single name in the history of this market, following the biggest market cap drop in the history of this market yesterday. I mean, can you keep up with this?
No.
To have moves that large off the back of earnings?
And the earnings, were they really that extraordinary? Perhaps you could make the argument that Facebook had some particularly stark warnings. However, can you really argue that these massive mega cap companies that account for such a big proportion of the U.S. indexes really saw some sort of dramatic change that should force these massive increases or declines?
Where's the confidence going to come from, Tom? If you can have a mega cap that large move 10, 15, 20% on a single day.
I think it shows a separation within the markets, as we've seen in economics on this Jobs Day, of two Americas. There are two corporate Americas, and as David Stubbs at J.P. Morgan brilliantly said halfway through last year, this is about technology and application of technology, whether it's direct as we perceive in these gamma stocks, whatever you want to call them, and others that are using technology like UPS. They're the winners. And some people might say a market, Tom, struggling to price things at the moment. Let's finish on this. The bond market plus crude. Want to look at twos. 123 on a 2-year a little bit earlier. We come back. We're still higher by 2 basis points going into this payrolls print at 121.53. You know all about the estimates on Wall Street. 125, the median estimate for payrolls. Top end 250. Bottom end minus 400K. For all of us, who knows? Crude up 1.7%, Tom. 91.80. And this is becoming a bigger and bigger problem for central banks around the world right now. They don't want inflation expectations, higher expectations to become deeply embedded. This is real life. You don't get to strip out energy from your world, Tom. It's in all of our worlds. Central banks try and do that. They can't do that anymore. 91.81, Tom, on WTI. This is a real joy, folks. You'd think Riccadonna and Agostini is an Italian place down in Soho. It's not. It's two brilliant economists down in the trenches of Bloomberg Intelligence doing great work. We're going to take today's jobs report, and as Lisa said earlier, she's watching wage inflation. You know it's out there. It's real. We're all falling behind. Carl Riccadonna and his colleague, Mr. Gabriel Agostini, with a piece of the week a few days ago on raging rents. Carl, how bad is the housing market, and what's it going to do to inflation and our paychecks?
Well, Tom, good morning. This is going to be a big feature of the inflation dynamics as we move later into this year. We know how hot the sales market has been over the course of the last 12 to 18 months. Interest rates are rising. Prices have gone through the roof in high double-digit growth rates. There may be some signs that things are leveling out to some degree, but as we move into a higher interest rate regime, those would-be home buyers will be pushed back into the rental market. And so this is going to drive a category in the CPI, which is 40% of core inflation, higher over the course of this year. And ironically or perversely, the more the Fed does to rein in inflation by raising interest rates or letting assets roll off of the balance sheet, the more that's going to make it less favorable for home buying and drive up rents even more.
Carl, you are acclaimed for the study of the x-axis. Now, we had 7% inflation last go-around. John Farrow mentions we have 7% inflation next week. How many sevens do you need in a row where Jerome Powell starts sounding like Mr. Bailey over in London?
Well, I think that those who are watching the underlying components of the inflation data, we realize that transitory is not panning out the way that folks thought it might over the course of 2021. However, we can see some very significant base effects emerging on the horizon. So not in time for next week's